out. It's also that kind of a day when portfolios are looking bruised and battered. It's not just the Indian markets that have seen a sharp cut, but it is a global kind of an impact that we're seeing. So a lot of questions right now, right, that we've been talking about all day. Is this something that's going to persist? Is the US going to go into a recession? What happens to India? What happens to global markets? What happens to the Nifty? But in this particular show, we're going to be talking about what happens to your portfolio. Is this a good time to buy the dip? Because remember, Indian retail investors are also very smart at doing that. What is the kind of strategy that you should employ in order to navigate the ongoing market sell-off? There are two ways of looking at it. In fact, various views on what you should do. And we're going to be speaking today with Hemant Rustagi, CEO of Wise Invest, and Pankaj Matpal, founder and CEO of Optima Money Managers. Welcome to both of you. Thank you so much. Pleasure to speak with you on the Mutual Fund Show today. Hemant, let me come to you. It's a tough day on the street for investors of every kind. But for mutual fund investors, I think at the end of the day, they would be the most secure knowing that their SIPs are going out on time. Is that the way you should look at it?
Oh, absolutely, Tamanna. I think you're right. This is a tough day. And in fact, this is the third time in the recent times that we are seeing such a day. We saw that there was a deep cut in the market when the election results were announced, and also on the day when the budget was presented. And this is the third time. And as you rightly mentioned, I think this time the reasons are slightly different. The more basically global reasons than the domestic reasons. But you're absolutely right. If you analyze the way the investors have been investing in mutual funds in our country the last few years, most of them are investing through SIP, which means that they are following a disciplined approach. They are committed to kind of hold this money for a longer period. And I think one important thing is that most of them have aligned these investments to their goals. So they have much more clarity in terms of how long they can hold these investments. So I think any investor who has kind of been investing in a disciplined manner has done the right thing by selecting funds as in line with the asset allocation. I think I would say that those investors need not really worry about the kind of deep cut that we're seeing in the market, because we know that volatility in the market is a natural phenomenon, and these times will come and go. But only difference this time is that the reasons are global, and we need to really wait it out whether the recovery that we saw in our earlier two occasions, whether we'll see that kind of recovery or it's going to take some more time.
Pankaj, let me come to you. Wait it out is some of the advice that is coming in. What about the question of buying the dip? Look at the next few days and what is going to happen here on. You are going to hear from central bankers. You'll probably hear from the Federal Reserve in September. You could see a rate cut. You could see a reversal of this trend. Is this a good time to start lump sum investment or bump up SIPs or start a new SIP?
Yes, Tamanna, say when we talk about mutual fund, generally, especially in equity, we expect a long-term horizon. Means investors invest with a long-term view. Considering that fact, I'll say that it can be an opportunity for investors. I'll not say that you invest the total amount in a single day, but definitely every dip is an opportunity for investors for investing in mutual funds. But Tamanna, I'll say one thing that considering the recent trend, investors have invested more in small cap, mid cap, and especially in some themes like PSU or defense. And we have been advising this that investors should maintain a balanced portfolio or proper asset allocation. So if investors have more investment or more allocation in small cap or themes like defense and PSU, is the time that they should realign their portfolio with their financial goals and reduce their exposure in these sectors and themes. But yes, they should stay invested.
Okay, so you should stay invested. But, I'll just take that forward to Hemant. The whole rage, two-part rage, one of NFOs, one of thematic funds, and especially in some of the sectors that Pankaj mentioned, defense, infrastructure, all of these themes which have really been running up. Is it the right time for investors to relook and reallocate, stick to basically the good old bread and butter, your large cap stocks?
Tamanna, it depends on the kind of investor you are. Look, the fact is that people who have been investing over the last many years have built a decent sized portfolio. They are comfortable with how equity market behaves. They understand the nuances of how equity market functions. Obviously, they reach a stage where they think that they have the risk profile to invest in these kind of funds. I mean, they can be fine, provided, again, of course, the important aspect always is how much exposure do you have to sector and thematic fund. Now, while there are thumb rules which say that 10 to 15% can be invested, but the thumb rule obviously always do not take into consideration your own personal situation. So it depends on, like I said, the kind of investor you are. But for the retail investors, if someone has been investing here thinking that there is an opportunity to make a quick buck, obviously not because there is a correction, even otherwise also, I think there is definitely, I feel that an opportunity, or also the time for investors to rethink their strategy as to how much investment they should be having, or if at all they should be having in that. Because my belief always is that if there are certain themes, certain sectors, they have the potential to do well going forward. And if you're invested in well-diversified fund, which have been performing consistently well, surely the fund manager will have exposure to these two or three or four sectors or segment that have the potential. Of course, it may not be as much as you actually can get when you invest directly into those, but they will definitely be participating through this diversified fund. So my point is that not because there is a correction in the market that we need to relook. I feel that for someone who is trying to build a portfolio over a longer period through smaller contribution should always stay away from sector and thematic fund. And if someone has included, surely it's time to kind of relook at that.
But today, what about today and now? It's very timely that we're doing this show today, on the 5th of the month. And people are figuring out what to do. They're probably looking at their portfolios. They're saying that, yes, I have made money over time. And I'm seeing some of those gains, which are still right now notional, evaporating. Do they have to wait? Buy, sell, hold is a very simple, basic kind of a query which viewers have been asking us. And let me put that to you now first, Pankaj.
Yeah, I'll suggest that investors should add or top up their flexi cap fund, or they should add flexi cap funds to their portfolio. And they can book profit from small cap fund, especially even then they have lost some good amount today. But still, I'll say that it's the time that you should book profit from small cap or exit from small cap if you have a large exposure. And flexi cap within diversified category looks better, or large cap index funds can be considered. And if you want to add theme, for example, you do not have exposure to theme, then I'll say that healthcare or consumption, these themes could be better compared to your defense or PSU, because see, thematic funds perform better within a certain period of time. So when we have seen that these themes have outperformed the broader market, so now it's a time that you should exit from those themes and add such themes where you are looking, where you can expect better performance.
Okay, so let me recap that. Very specific and important advice from Pankaj Matpal. He's saying move from your small cap funds and increase allocation in your flexi cap funds. You can look at large cap funds. If you're keen on thematic funds, then look at healthcare and consumption, which haven't run up as much as others. And remember, it's the recession-proof story, right? So that's why they call the defensives. Hemant, you have similar advice?
Yes, I think, but like I mentioned earlier, I think it's important for investors to realize what will work for them in the long run. If you're making any decision based on what is happening in the market today, trust me, if you see a recovery, if there is a, let's say, unscheduled rate cut by US, and then suddenly if you see a recovery, then the thought process will change again, saying everything is fine now, why should I make a change? So I think it's important not necessarily to look at only the market mood and how the markets are behaving, then make changes. As I mentioned earlier, I think one needs to really look at what will work in the long run. In the long run, for a retail investor, for someone who's trying to build a portfolio, as I mentioned earlier, I think the key is always to go into well-diversified category. And I think that if someone was keen on having exposure to all the three market segments, for example, the multi-cap funds can be great addition. Then there are a large and mid-cap fund and of course the flexi-cap fund. So my view is that, like I said earlier, not because there is a correction in the market, but otherwise also I think investors should relook at their portfolio, realign if there is a need, and try to build portfolio with well-diversified fund. And of course, those who have the risk profile, who understand the attendant risk, can obviously have exposure to different markets, different sectors or different themes.
Okay, so keep it steady, hedge your risks, and at the end of the day, remember, it is the domestic investor who's been putting his faith or her faith in mutual funds that has kept Indian markets relatively fine. I mean, I know you're looking at a 600 plus point cut on the Nifty today, and it's seeming painful, but if you compare with what's happening in the rest of the world, it's definitely not that bad. All right, let's take specific queries, and remember, if you want to write into us or you want to ask our experts your questions, the numbers on your screens. Let's start with Piyush Dhule's question. He's 28 and asks that I have 60% exposure to mid-cap and small-cap sectors, but should I reduce the exposure in the current market scenario? Thank you for your question, Piyush, and thank you for watching. Pankaj, let me come to you first for your response. So it's not unusual to have investors like Piyush, and especially he's 28 only, who have a larger exposure to mid and small caps. Do you think it's time to relook at that strategy?
Exactly, Tamanna. Actually, 60% allocation in mid cap and small cap is not a good choice. And now also means my suggestion, he should reduce exposure from small cap at this moment. If he wants to exit even, that is good. Because we are seeing that small cap have run well, and is the time that should have larger exposure in large cap, flexi cap category, because fund managers have choice. They can allocate funds according to situation. So flexi cap can be a better choice at this moment, but definitely from mid cap and small cap, Piyush should reduce his exposure.
Okay, so reduce your exposure in small cap and mid cap. Anyway, it was not a great idea to have 60% exposure to these sectors. Hemant, what would be your advice for Piyush?
Well, Tamanna, I would say, look, there are three segments in the market: large cap, mid cap, and small, and all three have an important role to play. Of course, the key is to have them in the right proportion. Now, how do you decide the right proportion? One is to follow a thumb rule, which says that for any investor who's investing over a longer period and who's not very well experienced, should always have a bias towards the large cap. Now, that can be either through pure large cap fund, or it can be through flexi cap fund, or even large and mid cap fund. So that again depends on the kind of investor you are. So I think someone like him, if he's investing for a long term, even then I think the exposure is high. He needs to kind of cut down that exposure. Now that can be done in a phased manner. It need not be done on a single day or immediately. It also depends on whether he is looking to increase his SIP. Now, for example, if he's investing, let's say 10,000 rupees and 6,000 is going into small and mid, and he wants to add another 10,000, he can actually invest that money in the large cap or a flexi cap or a large and mid cap, rather than kind of, stop investing in this. So I think there needs to be some clarity on how you look at your investment process going forward, and what is the size of the investment and how much money are you investing in this, because the percentage does not always give you the right idea.
All right. One more question coming in, and this is from Mahendra, age 36, asks, is it a good idea to invest in foreign funds right now, given they may consolidate further and could be up for grabs for lower valuation? Excellent question, Mahendra. And Pankaj, this is what I say about the Indian investor who is largely optimistic. I mean, they're looking at an Nvidia, all the mega cap stocks which have been completely liquidating, and saying that I watched these stocks from afar and thought they were out of reach. Are they in reach now? What would be your advice?
Tamanna, adding international funds to your portfolio is a good idea. But at this moment, if somebody wants to invest, I'll say Indian markets are looking better. So have larger exposure in Indian market only, because you do not know the bottom of these funds. So not a good idea to add at this moment these Nasdaq or this kind of funds, especially US market I'm talking about. Better invest in Indian market.
Okay. All right. So it is a good idea, but not right now. And, an important point over there, that in relative terms, do the Indian markets fundamentally look better? Well, absolutely. Perhaps they do. We'll take a very short break, but we're coming back with your queries. We're going to focus on your queries in today's show. It's a day when people want to know what to do with their portfolio, and we'll try and help you out as best we can. Very short break, and we're right back.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
This is NDTV, and you're watching NDTV Profit. In association with Samman Capital.
Welcome back. You're watching the Mutual Fund Show. Now, this is the portion of the show where we take your queries. Ananya has written in, age 35, says, I want to buy the dip, but do not believe mutual funds are the right avenue. So is it a good idea to rely on ETFs to buy the dips? Ananya, excellent question. Thank you for writing in. Hemant, let me come to you first on this. People do want to buy the dip. Ananya's point is a valid one. Why should she go through mutual funds, pay that fee? Should she just look at ETFs right now?
Well, I think this is an important question, Tamanna. It's not only because on a particular day you want to buy a dip, and this is the issue that we keep discussing again and again, whether I should go for active fund or passive fund. Again, I think there are pros and cons of investing in both. Of course, there is no doubt about the fact that if you're buying an ETF or an index fund, because there is a cap on the expenses, the costs are lower, right? And of course, there is no human bias because these ETFs and index fund, they track a particular index. So in that sense, yes, I mean, there are advantages of that. But I think, again, there have been occasions, there will be occasions even going forward, where you'll see that actively managed funds, not necessarily maybe in the large cap, but in the small and mid cap, and also those options which give you a mix of different segments can do better. So it clearly depends on, as an investor, whether you want to go in for a passive fund or active fund. But I think both have pros and cons. And also, let's not forget that in the rising market, you may see that the passively managed fund will do better But in the market, when the market turns choppy, or if you see a steep fall, there is no protection because the index funds have to be fully invested in all time. Whereas in the active fund, the fund manager does have the liberty to kind of keep being in cash for some time. So, like I said, there are pros and cons of both. You can always have a portfolio which has a mix of active and passive funds.
But Pankaj, right now, the question is that Ananya wants to buy the dip. To buy the dip, should she look at ETFs?
Not exactly. As Hemant said, I agree with him that ETFs as well as mutual funds, both are important in the portfolio. So at the dip, you can even buy mutual funds, because when you invest in mutual funds, when markets are down, the NAV will be low. So that can also be a good choice. So both can be in your portfolio, and the advantage with the actively managed mutual fund is that fund managers, they try to reduce the risk. They try to manage the risk. So that is why you cannot ignore active mutual funds. As you want to build your portfolio, you have space for both the things.
Okay, Manish writes in, age 25, asks, I don't feel much comfort in equity valuations right now. Can you suggest some safer mutual fund bets for someone waiting for a correction? I think, Manish, your question has come to us, or you've sent this question to us before that correction. Having said that, many will argue a 2.5% cut in the Nifty is not really a correction, even in your broader markets. But Hemant, I'll let you field that question first. What are safer bets for someone waiting for a correction? And is that wait now over, or has the correction just started?
No, Tamanna, I think we can't say that the wait is over. I mean, we just discussed that there are global issues right now. We need to really see how the market pans out from here. But, if someone is looking at a safer option where the money can be kept and, invest in equity at the right time, the question is, what is the right time, whether you're able to time it properly or not. But I think the options would be maybe a liquid fund where the money can be kept. And as and when one feels that there is an opportunity to get in to equity, one can do that. But I think timing that is always very, very difficult. So maybe one way I would say is to kind of do systematic transfer plan. And maybe you can do it on a weekly basis, you can do it on a fortnightly or even monthly basis. And within that, if you see a dip in the market, then maybe you can switch a larger portion of that rather than trying to time in market, because it has happened on so many occasions that investors have been waiting for correction. When the correction does happen, they feel that this will go down further, and suddenly there is a U-turn in the market and they lose the opportunity. So I think timing that can be a bit difficult. STP can be a good option. Like I said, in the process, if you see that there is a fall, try and kind of transfer a larger sum through switch.
Timing the market is actually a losing proposition one way or the other, which is why the good old SIP investors at the end of the day always feel that comfort. Perhaps they're not really crying buckets today like a lot of investors may be. Pankaj, would you agree with that? That it's tough to time the market and wait for a further correction? But the question specifically was, suggest some safer mutual fund bets. What would you reply there?
See, I'll say two options. One, as Hemant said, that one should invest in a staggered manner, so STP can be a good choice. Second is, one category is there, which is called balance advantage fund. So this category gives you this opportunity that you invest in one fund, and fund managers, they take a call that how much in equity, how much in debt. So balance advantage fund can be a good choice, that you invest your money and leave it on the fund managers. But within this category also, funds are managed differently. So select a fund which has lesser allocation in equity at this moment, like ICICI Prudential Balance Advantage Fund can be a good choice in this category, or Kotak Balance Advantage Fund. So this kind of category can be a good choice. Or if you want lesser risk compared to this even, then there are conservative hybrid funds or equity savings fund. These kind of categories can be considered.
Okay. So you have to look at various categories at this time, and STP is a good idea because tough to time a correction. It could be today, it could not be today. I mean, you will hear people saying with complete confidence that this is just the beginning. If things turn by tomorrow, then they're not going to be really able to tell them anything. Let's take this question from Sahara. Nagraj says they've received a security deposit of 12,000 rupees, looking to invest this amount into mutual funds. Where can I invest in? Let me just add one bit to that question and take it to Pankaj first. If Sahara was sitting today with this 12,000 rupees, would you say deploy the cash today? or stagger it over the next few days?
Again, it depends that how much money he has already invested, means his portfolio size. But if somebody wants to build a portfolio now and the horizon is longer, this amount can be invested in one go today.
Okay, can be invested in one go today. That's interesting. Hemant, someone sitting with a bit of money and anyway looking to deploy, today is a good day?
Well, today is a good day, but we don't know whether it's stopping here or the correction will continue. It should be that tomorrow you start feeling that, okay, I kind of acted very fast. So again, you can stagger it. Like I said earlier, it's very, very difficult to time it to perfection. Maybe if you want to invest 100 rupees, maybe 30, 40 rupees, you can begin investing and then maybe wait and see how the market pans out. But in this particular case, if he's saying he has a security deposit of 12,000, I don't know if he has to kind of refund it after a year or what is the time horizon. I think all that is important. So even if the market presents a great opportunity, if the time horizon is not long enough, I would say stay out.
Yeah, but I mean, at the end of the day, they already want to deploy that 12,000 rupees. The question is about whether they should do it now and at one go. If you have a longer term perspective, then there's no harm in doing that, because trying to time the exact bottom of any market is near impossible and maybe a fool's chore. But steady and slow does win the race and will continue to do so even on a day like today. Thank you so much, Pankaj. Thank you so much, Hemant, for joining us. Thank you for all of our viewers who've tuned in. If you have a question for us, those WhatsApp numbers are on your screen. Until we see you today, same time, same place. That's all the time we have on the Mutual Fund Show. But stay tuned, a lot more coming up on the other side on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Good morning and welcome. This is NDTV Profit. My name is Alex Matthew and you're watching All You Need to Know. Like the name suggests, we'll bring you up to speed with everything that you need to know to start your day ahead of the curve. Let's start with the headlines. Wall Street continues to see sharp declines, but it's off the low point of the day. The Dow loses over 1,000 points, while the S&P 500 and the Nasdaq drop over 3%. But as I said, they recovered from the low point. US Treasuries lose some steam. Bond yields recover from Monday's low. 10-year yield rises 4 basis points to 3.84%. The early risers in the Asia-Pacific region see a sharp rebound. The Nikkei 225 rises over 10% in early trade. The Kospi and the Australian benchmark trade in the green. Bangladesh Prime Minister Sheikh Hasina resigns and flees the country. Army Chief Waqar-uz-Zaman says that a new interim government will be formed with participation of all parties. Bharti Airtel profit rises 128% sequentially to 4,717 crore rupees in the June quarter, beating estimates on the back of a one-time interest waiver. SEBI approves 5 IPOs, including Bajaj Housing Finance and Bazaar Style Retail. Adani Energy Solutions raises 8,373 crore rupees through qualified institutional placement, receives bids of approximately 6 times the base deal size. And the central bank proposes new rules to govern algo-based lending by banks and other financial institutions. Now, selling has eased somewhat in global equity markets after the frenetic action at the start of the trading week. Wall Street still saw sharp cuts, with the Dow losing over 1,000 points and the S&P 500 and Nasdaq dropping over 3% each. Even treasuries have lost a little bit of steam in the rally that has pushed the yield on the 10-year benchmark lower by nearly 40 basis points over the course of just a week. Overnight, the yield on the 10-year benchmark rose as much as 4 basis points to settle at 3.84%. There's a rebound that is playing out in the Asia-Pacific region as well, and you have the Nikkei 225, which is off the high point of the day, but is still trading with gains of close to 8% at this juncture. You have the Hang Seng in Hong Kong, which is trading with gains of about 0.7%, and the Chinese markets, which are positive right now. The early indicators are pointing to a positive start for the Indian equity markets as well, at least based on the Gift Nifty. The implied open points to a 200-point gain for the Nifty 50 at the start. Let's get you some opinion or some understanding and perspective on what happened at the start of the trading week and also heading into trade yesterday. We spoke to Raymond James, who's a chief market strategist, or rather we spoke to Matt Orton, who believes that holding cash in the current market scenario might not be a bad idea.
We know a cut's going to be coming. The question is just how big is that cut going to be? So remaining in cash is not the trade. Whenever you start a rate cutting cycle, cash unambiguously underperforms in every single case. So I think investors who are moving there are doing it more from a positioning standpoint. They're taking profit on some trades and looking for other opportunities, which isn't a bad idea in this sort of market. But I think a lot of that cash, to my point earlier, is going to need to find a home. And when you see some stocks that are down 10%, that have rock solid balance sheets, have just posted good earnings, that's a good opportunity to start to maybe redeploy that money and put it to work, especially if you do get a little bit of encouragement from the economic data.
All right. Now, the other big story that we've been tracking is the unrest, in Bangladesh. And that is on account of the protests that have been ongoing for several weeks now. And yesterday it reached a flashpoint with the Prime Minister Sheikh Hasina fleeing the country and the army and the army chief suggesting that a new government will be formed. But there continues, as I pointed out, to be unrest. The question is, from the Indian perspective, apart from the fact that we share a border with this country in unrest, are Indian companies set to face tribulations, face pain amidst that uncertainty? My colleague Mahima is joining in to give you some perspective on which companies are most exposed to Bangladesh. Mahima, what do you have?
Right, Alex. So a lot of companies have exposure in Bangladesh or trade with Bangladesh. Now, I'll break that down sector-wise for the viewers. In the FMCG pack, there's Marico, where 11% of revenue comes from Bangladesh and 44% of the total international revenue comes from Bangladesh. Then there is Imami, which has a wholly owned subsidiary in Bangladesh, and 6% of Imami's total revenue comes from Bangladesh. For Asian Paints as well, 10 crores of revenue, 12 crores of royalty comes from Bangladesh, and they also have a loan from Standard Chartered of Bangladesh, and overall share in profits is around 0.2%. For Pidilite has two subsidiaries in Bangladesh. The first one is Pidilite Specialty Chemicals, where 4.23% of the revenue in FY24 came from Bangladesh. Jubilant Foodworks also has exposure in Bangladesh. They have recently completed 100% acquisition of Domino's in Bangladesh, and they operate around 26 stores in Bangladesh. Godrej Consumer also has a wholly owned subsidiary in Bangladesh. VIP Industries, this is an interesting one, where 30 to 35% of its capacity is in Bangladesh. So a lot of their manufacturing happens in Bangladesh. Then we also have railway companies like RITES, which has a contract of 200 broad gauge coaches, which is around 906 crore order. Texmaco also exports freight cars to Bangladesh, and BEML also has presence in Bangladesh. Defense companies like Garden Reach Shipbuilders has a total contract of $16.5 million for Inland Water Transport Authority. Oil companies like Indian Oil exports products like gasoline, Jet A1 gasoline, etc. To Bangladesh. Telecom companies like Airtel operates in Bangladesh via Robi, etc., where Airtel right now owns around 28%. Pharma companies like Sun Pharma has inaugurated a new plant recently in Bangladesh, and overall production capacity in Bangladesh is 1 billion tablets and capsules per year. Lastly, power companies like Adani Power also has exposure in Bangladesh. Adani Power's Goda Ultra thermal power plant supplies 100% power to Bangladesh, and their revenue in FY24 stood at around 7,500 crores. NHPC and BHEL also have a JV where Rampal power station of 1320 megawatt power station is being built in Bangladesh. And lastly, even auto companies like Hero MotoCorp has exposure in Bangladesh, wherein they have manufacturing plants overall in a lot of places in Bangladesh. So this is a whole host of companies that have presence in Bangladesh and could be impacted because of this crisis.
All right, thanks so much for getting us those details, Mahima. Now, let's get you the latest on the F&O front. As I pointed out, the implied open suggests that we will be in the green at the start today. Let's see if that pans out. In the meanwhile, of course, yesterday you saw the India VIX spike exponentially. What are the implications for the F&O space? Chinmay is standing by to break down the latest data for you. Chinmay, what are the key levels to watch out for?
Well, among the key levels, the Nifty August futures closed 2.5% lower at a premium of 58 points, with the open interest declining about 3.8%. Followed up by Nifty Bank August futures, which were also 2.5% lower, but the open interest grew by 13%, indicating a short build-up. In terms of levels, the max OI for Nifty stood at 26,000 for call contracts, and for put contracts, the max OI was at 24,000, indicating that the level could be a support for the day. Moving on to the OI gainers and losers, first up we have the gainers in Dr. Lal Path Labs and Samvardhana Motherson, where there was longs unwinding. In OI losers, we have Birlasoft and India Mart indicating short longs unwinding. My bad.
All right. Thanks so much, Chinmay, for getting us those details. Let's talk about earnings next. And we've got Bharti Airtel that reported its Q1 numbers. If you just had a glance at the numbers, it would suggest that it was an incredible quarter with a beat on the profit number estimates, with the profit gaining over 100%. But if you look at the fine print, it tells a slightly different story, because there was a one-off to talk about. And to tell you more about that, we've got Rucha joining in. Rucha, what can you tell us about the performance as well as that one-off?
So you're right, Alex. If we look at the numbers, you would see that profits is a beat. However, this was a beat due to one-off item, that is exceptional item, so which is largely not related to operations. So if you look at numbers were largely in line with estimates. Revenue was up about 2.5%. EBITDA margin came in at 51.8%, but expectation was at 52.6%. So slight bit of disappointment over here. Net profit, if we exclude the exceptional items, net profit was down about 0.9%, so largely in line with what was there last quarter. Now talking about India operations, which is one of the main focus of the company, revenue was up about 2% at around 29,000 crore, while margin came in at 53.7% versus 53.6% in the last quarter. So numbers were largely in line with the last quarter. Wireless revenue, which is another important metric for India operations, was up around 2%. So talking about numbers are pretty stable, healthy set of numbers. Now talking about ARPU, that is average revenue per user, came in at 211 versus 209 in the last quarter. Now the management targets rupees 300 as the average revenue per user, and it indicates that 300 is the number wherein which will bring the financial stability in the telecom business. Talking about capex, we just had 5G auction, etc. So the total capex for the quarter came in at 8,000 crore, of which majority of the chunk belonged to the India operation at 6,700 crore approximately. The company also mentioned that it has renewed its license across the circles wherein the license was expiring. Now talking about the customer base again was largely in line with the last quarter, 0.7% QOQ growth in terms of India. However, Africa had pretty weak numbers, largely because of the currency devaluation. Now talking about what the management says, etc., the call is scheduled to be held at 2:30 today, so we'll get more insights and we'll be able to read more within the numbers.
Got it. All right. Thanks so much, Rucha, for breaking that down for us. Let's talk about ONGC. It reported its first quarter numbers as well, and it was a bit of a muted quarter, to say the very least. The revenue was flat and the net profit saw an 11% decline on a sequential basis. Mika is joining in to give you some perspective as to why that came to pass. Mika, take it away. Morning.
Yes. A weaker set of numbers was expected, Alex. Revenues flat at 1.66 lakh crores. EBITDA was down 6%, and it didn't, did miss estimates. Margins did contract very slightly at 13.07 versus 13.92. Net profit was down 11.19%, however, in line with estimates. Now, one of the main reasons what led to a fall in revenues as well as profits was the gas production. This is in terms of production as well as realizations. Now, when you look at the production performance as a whole, the crude oil production was down 1.4% on a year-on-year basis at 5.237 million metric tons. Gas production was down 4.1% over the same period to 5 billion cubic meters. And when we talk about the net realizations, nominated crude oil, it was up 8.8% year-on-year at $83.05 per barrel, which is compared to over $76 last year. Our JV crude oil realizations was also up 14.2%. This is crude oil, produced by the company via joint ventures. But gas realizations were down 3.1% year-on-year at 6.5 per million metric British thermal unit. But this is what the government sets as a cap for realizations for the gas produced by ONGC via its nominated blocks.
All right, let's talk about earnings that are set to come today. And one of those is Tata Power. What are the key numbers to watch out for, Mika?
Yes. So, when you look at it as a whole, it's a good set of numbers as per Bloomberg estimates. Revenue may rise 10.8% to over 16,800 crores. EBITDA, however, might remain flat at 3,004 crores. Margins could contract 17.8% versus 19.6% a year ago. But, however, net profit might rise 9.3%. When you talk about the factors impacting earnings, well, higher revenue growth is expected mainly due to the drop in coal prices, thermal and solar power generation during the quarter, given the peak power demand that we saw during Q1 FY25. And thermal plants are also expected to have a higher plant load factor due to the government mandate of, ramping up power production via thermal plants, and also the renewable focus strategy that Tata Power does have in play could also, impact and benefit the company positively. One thing we need to watch out for is the capex and expansion plans in more detail for the renewable energy segment.
Got it. All right, thanks so much for getting us those details, Mika. Now, let's talk about the other major company to watch out for in terms of earnings, and that's TVS Motors. And you've seen several companies reporting their numbers for the first quarter, the automotive space. Let's talk about what the key numbers are for TVS. We're expecting a revenue growth of 15%, but to tell you about the key numbers, we've got Puneet joining in. Puneet, revenue expansion, but how is the bottom line looking?
Well, it's a very strong bottom line expected from TVS Motors in this particular quarter. As you rightly said, revenue is expected to rise roughly 15%, but that will also lead to EBITDA growth of roughly about 23% led by strong operating leverage for the company. In turn, margins are expected to rise to roughly by 70 basis points to cross 11% again, coming at around 11.3%. Now, because of this, net profit is also expected to rise by about 19% to about 561 odd crores. And the growth is obviously in revenues led by volume. So a strong volume picture already reported for April to June. For quarter one, the total volumes grew by roughly about 16% to come at 10.8 lakh units, while two-wheelers have grown roughly 15%. The exports growth has also been very strong to come in at 12% at around 2.5 lakh units in this particular time frame. A couple of things to note for in this particular quarter has been that the company informed the exchanges that for Norton, which is one of the acquired companies over the last 3 to 4 years post-COVID, they are planning to launch 6 models in this particular brand over the next 3 years. And this is very key because since it's the company acquired Norton, they haven't launched any products. So this is going to be one of the key things to note, watch out for if any more details are there. And commentary on the two-wheeler EV landscape specifically, because we've seen the FAME 2 end on 31st March 2024, and we've seen that EV sales has slowed down, and TVS Motors one of the main competitors there. So a couple of watchables, but expecting a very strong quarter from TVS Motors.
All right, thanks so much, Puneet, for getting us those details. Certainly one to watch out for in trade today. It's time for a very quick break on this program, but listen in to what Ajay Bagga had to say about the fall in the markets yesterday as we head into this break.
I would say very concisely, stay invested, regularly invest, if possible, on the entire market, because on your own, finding out the sectors which will rotate and take these markets higher will be difficult. Fourth, the biggest risk is not being invested. Biggest risk right now is not having any skin in the game. So it's not that your portfolio is falling. That's the biggest risk. The biggest risk is not being a participant in the markets, because when these markets turn, they will turn so fast that in 2 weeks, the entire year's returns will come.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
All right, we've already discussed several stocks that you should watch out for in trade today. Let's talk about some more. And to tell you about the first list of the stocks to watch, we're joined by Varsha this morning. Varsha, what's on your list today?
Well, good morning, Alex. So, yeah, starting with Tata Chemicals, weak set of numbers, but were on expected lines. If you see, revenue decline was due to lower realization year-on-year across regions. Profit impacted due to lower soda ash prices and subdued demand, and due to price cuts in November due to rising competition. Now, soda ash prices were under pressure due to economic slump in China and decreased demand of glass products in EU. Recovery could take 12 to 18 months. Then we have a Triveni turbine, wherein revenue from operation grew 23%, which were highest ever achieved in quarter. Domestic sales increased by 27%, while export sales increased by 19%. Highest everly quarter order booking stands at 636 crore, which grew 40% year-on-year, while total order book as on 30th June stands at 1,726 crore. Exports order booking contributed to 66% to overall order. Then we have Motherson Sumi, wherein revenue growth was supported by increased volumes and content on account of automotive mega trends. Revenue resilient was there despite impact of higher raw material and startup costs mitigated with operational efficiencies. If you see EV revenue grew by 50% year-on-year, and there were two greenfield plants, wherein first plant commenced operation in July 24 and second is expected to come by Q1 of FY26. Lastly, we have Deepak Nitrite. Profit did meet estimates, though subdued quarter-on-quarter. Advanced intermediates grew almost 1%, while phenolic segment grew 22%. So overall, numbers were led by phenolic segment. EBITDA margin increased due to operational efficiencies, and overall net profit decreased quarter-on-quarter due to lower other income.
Right, thanks so much, Varsha, for getting us those details. Let's round off the list then, and we're joined by Anushi to tell you about a few more stocks, including Brigade as well as Schneider Electric. What are you picking up, Anushi?
Hey, morning Alex. So I'll start off with the earnings list first. Now, the Brigade has come out with its Q1 FY25 numbers, wherein they've reported about a 65% growth in their revenues, while the EBITDA saw about a 67% of an increase. Now, both of these were above expectations. Again, in other key highlights, also the pre-sales saw about a 9% growth at 1,086 crore, while their pre-sales volume rose to about 1.15 million square feet. Now, if you look at segment-wise performance, real estate was the clear outlier here with about 105% growth, followed by leasing and hospitality seeing about a 23% and 11% growth. Moving on to Schneider Electric now. The company reported almost a 20% of a growth in its revenue, while it's the EBITDA which is in focus with a 67% of a growth here. Now this EBITDA, we are seeing this increase because of two reasons. One is the material cost contribution to the overall revenue has gone down to 60% as compared to 63.7% in the last quarter. And employee cost contribution again declined to about 13% as compared to 14% in the last quarter. Now order book status of this has new orders increased to about 19% at 531 crore, which took their order backlog to about 1,294, which is again a 15.6% of a growth here. Now coming to other stock in focus is Power Mech Projects, and this is on the basis of an order win of 111 crore from a captive power plant in Nigeria. So this order pertains to operation and maintenance of the 400 megawatt captive power plant situated there. The execution timeline for the same stands at about 2 years, but this is not the only order win. Even if we go back a few days ago, the company had received another order of about 143 crore, and this is from Meenakshi Energy. So we are seeing domestic plus international orders coming in from Power Mech. So these are the three stocks that are in focus today.
All right, thanks so much, Anushi, for getting us those details. And there's one more stock that we should be looking at today, and that's Interglobe Aviation. This is on the back of a note that has been sent out by MK. It's interesting because they've maintained a buy, and there's an upside that is indicated based on the target price of as much as 25%. To tell you about what that note contains, I'm joined by Harsh this morning. Harsh, what's in that note?
Well, Interglobe Aviation has had a 18th anniversary event, and pursuant to that, they've launched a slew of new premium products and premium offerings for customers. This should, of course, further augur an already very strong market share that Interglobe Aviation has and Indigo under the brand has in the Indian skies. You're seeing 60% plus in terms of that market share, expected to hopefully inch upwards. But what MK is really suggesting or bringing out is, as part of this event, they have launched their Indigo Stretch offering, which is a business class domestic offering. The introductory price for that is 18,000 rupees for the Bombay-Delhi route, and it's going to get launched somewhere mid-November. That's the expectation. Now, this was much awaited, and of course, this should further augur market share. MK very bullish on this one, 5,300 being the target price. You also have a City Note, 5,200 being the target price. So 20% plus upside by both of these houses on this one, Interglobe Aviation. Keep your eye out on that.
All right, thanks so much, Harsh, for getting us those details. I was very quickly taking a glance at the Asian markets, and they look sanguine. They look good at the start today, and we've also got an indication for a positive start for the Nifty 50. That brings us to the end of this particular edition of All You Need to Know. Lots lined up ahead on India Market Open. Do stay tuned. This is NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with All You Need to Know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right
Hello and welcome. You're watching India Market Open. It's Tuesday and today looks so much better than what it did look like yesterday. It's wild, wild west for global equity markets. Big falls, big recoveries. Of course, this is no one can call this a top or a bottom. We've agreed on that, but there's so much happening.
आप आए बाहर आए
आप आए सर्दी लेकर आई
Yeah, but gyrations across the world, very difficult to call this as the one which will reverse the whole thing, but it certainly looks positive because the yen has also made the change versus the dollar. So lots happening out there, but today is a day of bounce for sure. Must say, Tamanna called it yesterday.
Well, I don't want to toot my own horn, but thankfully you've done it. But actually, if you watched all of our coverage yesterday, we talked about a couple of things that could happen, and one of them was very strong policy statements. You heard from the Japan finance minister, you heard from the Japan prime minister. So that effort to sort of talk down the bears has been ongoing since yesterday. Very positive service PMI data, service sector data out from the US. So that also has contributed to change the mood, and of course technical factors. Now, having said that, it wasn't a rough night from our perspective for US trade. But look at the US futures. US futures have bounced back after the worst day of trade in 2 years. We should look at what's happened last night in US markets, because it tells you that the story is neither over nor is it going to get so bad, but there is more to see. I mean, your Nasdaq was down 3%, your Dow was down over 1,000 points. So there is a lot of pain, and some might laugh it off as one correction, etc. But there are concerns persisting on what's happening in the US economy, and it is wait and watch. More data will be expected to know which way that wind is blowing. Now let's just talk a little bit more about what happened. The AI sell-off is one theme which could last a little longer than the kind of correction we saw. Because remember, AI-led stocks had run up the most as well. So for example, Nvidia lost 6% and Apple was down about 5%. So companies which are betting very heavily on AI and were running up because of that could see a bit of a pullback. Meanwhile, definitely, like I said, positive data from the service sector. The July service PMI was up to 51.4% versus estimates of 51%. That has seen a boost, which is why you saw the 10-year also rebound to some extent. After that positive data, it was at 3.84%, so higher than yesterday. Not necessarily a bad thing. Usually we like a lower 10-year US Treasury price, but not necessarily a bad thing, because we swung to the other extreme of poor economic data yesterday. Crude has also rebounded from its lower levels. Remember, crude was feeling the pressure because of concerns of a global recession, but the Middle East crisis escalating and concerns that this will get worse has seen a bit of a jump there. The NYMEX up nearly 2%, while the Brent was at 77.29 a barrel. Asian markets, though, is the story this morning. I mean, look at that. Nikkei up 9%, was at one point up 10%. At one point in trade, pretty much all the losses from yesterday regained. Kospi doing very well as well. Last I saw, Kospi was up about 5%. So you have seen Asian markets, which were most badly hit, seeing some kind of a rebound. The implied open is what we should see, because India also could see a good start, at least 174 points up as far as the Nifty implied open is concerned. And just one more data point before we get to Edward Yardeni, because it's all about the flows. Look at the flows numbers yesterday. Astonishing. The highest FII selling yesterday since the 4th of June, when the election results came. Over 10,000 crore rupees were sold. DIIs bought. All of you whose SIPs go out on the 5th of every month, you've possibly contributed to that. 9,156 crore rupees in buying so far highest so far in 2024. All right, Dr. Edward Yardeni, President at Yardeni Research, joins us this morning. Very good morning to you from where we are sitting, but thank you so much for joining us, and always a pleasure to speak with you. I want to understand from your perspective how persistent these recession fears are in the US.
Well, clearly, part of the reasons for the sell-off on Friday was the weaker than expected employment report for July. However, we had a really close look at it and concluded that it might have been the weather. I know that the Bureau of Labor Statistics said that Hurricane Beryl, which hit Texas in early July, didn't have an impact, but still there was plenty of evidence that the weather was bad enough around the country that it might actually have depressed the data. And today's, as you mentioned, today's data on the non-manufacturing purchasing managers look pretty good. So all in all, I think the economy is still pretty resilient. I think we'll get over this latest recession scare. You know, we've had this recession fear for the past 2 years. It's the no-show recession. It's the most widely anticipated recession that hasn't appeared. And there's still concerns that it might at some point, but I don't think it will.
Dr. Yardeni, good evening to you.
Evening.
This the fears of the market and three-pronged, right? The recessionary fears, the yen carry trade unwind, which I think was the principal one, and possible lurking geopolitics. Now, my question is it possible to predict whether the extent of fall that a yen carry trade unwind can do has already happened, or is it difficult to call that out right now?
Well, it's difficult, but that doesn't mean that I can't go and agree with your answer in the affirmative to your question. I think we may really have seen of the carry trade unwind happen pretty quickly, and I think to the extent that key Japanese officials are basically saying either implicitly or explicitly that maybe they're going to be careful about any further tightening, that in turn would lead to some stabilization in the yen. It certainly has seen some improvement in stock prices in Japan. And so this earthquake that we saw in Japan, it clearly spread very quickly to the rest of the world, but I think it may be calming down already.
Dr. Yardeni, hi. It's also Samina joining in. Let's talk about what this means for countries like India. Sure, there's Japanese carry trade unwinding, but Indian markets have never been a beneficiary of borrowing in yen and investing it in Indian equity. The carry trade is our own story, the Indian rupee and the dollar, and sometimes may be a Swiss franc. So do you feel that Indian markets are insulated at this stage, and maybe we could be beneficiaries of everything else going wrong on the Japanese carry trade?
Well, I do. And look, if the Japanese carry trade isn't, it is still going to be a problem, and it creates some sort of global issue in the global credit markets, causing a global recession, then obviously India would do poorly in that kind of environment. We would all do poorly in that kind of environment. But I think what we've seen is that inflation has come down quite dramatically. By the way, I think one reason that inflation has come down without a global recession, certainly now without a recession in the US and without a recession in India, is that we've actually seen a depression in the Chinese real estate market, and the Chinese have tried to offset that by dumping goods in global markets. And so we've seen a lot of deflation, a lot of price cuts in the exports of China, and a lot of high value added kind of goods, including automobiles. I think that in turn is depressing Germany, which used to be able to sell a lot of cars in China. Now they have competition with all that. So this has all allowed central banks to stop tightening, start moving towards easing. And that suggests that the global economic outlook is pretty promising. And I think the US and India both benefit from that kind of outlook.
Dr. Yardeni, just from the Indian perspective, trying to understand whether India now continues to look or looks like an increasingly attractive market from the context of foreign flows. Since the start of this year, at least, foreign flows haven't really come in. There was a thought that post the elections and post any political uncertainty being moved away, you would see that. It's been quite the reverse. Do you see that picture changing?
Well, I think that foreign flows will contribute to the bull market in Indian stocks. I think a lot of foreigners would like to just get a sense that the Modi government following the election will still be able to get through a lot of the reforms that are necessary to make the Indian economy more competitive. But a lot of that's already happening. Infrastructure spending is certainly occurring. A lot of the kind of transportation problems that India faces with regards to global companies, I think those will be resolved over time. And so I think foreign investors will continue to increasingly go to India. The only problem is it's not cheap. It's not as though it hasn't been discovered. The Indian stock market has done extremely well, but rightly so.
Right. Dr. Yardeni, one quick question. As an investor, what should one be looking to do? Should investors be waiting before they make portfolio changes? Should it be incremental tweaks? Should it be big adjustments with all the information that we have at hand right now?
Well, I have to admit that I am in sort of the Warren Buffett camp and the Professor Siegel camp that believes that stocks should be held for the long run. You buy good quality stocks with maybe paying dividends, you put them away, and you should do very well over time. Trading stocks is a full-time job. So if you have a job, it's pretty hard to do it. But I would say that this sell-off presented some opportunities, particularly in technology in the United States, as well as financials. So I think we'll see some opportunities in the U.S. And India, I think, will continue to perform well.
Okay. Well, Dr. Yardeni, thanks so much for joining in today. I've just signed up for Yardeni Quick Takes, and we'll look forward to reading in praise of profits. Well, that's the view from Edward Yardeni, and believes that India could be in a sweet spot. Yen carry trade unwind, one of the principal reasons for the sharp drop, he believes at least. And he believes that that is probably more or less done. At least that's the submission that I got. Let's wait and watch if that indeed turns out to be true. But,
just one more thing in terms of summation. I found it very interesting that this jobs data that shook up the whole world for the last 24 hours, he's saying it's the weather. It's the weather, especially in Texas, hurricanes, which caused less people to come out and look for jobs, caused the unemployment rate to go up, highest in several months, and caused jobs data to look skewed. And that's a great perspective to have, considering it caused such a huge fear.
No, and my only thing is also with this whole Japanese carry trade, while we've got pretty emotional about this yesterday as well, and world markets did. The fact is, and I've read quite a bit of stuff that came out and said that Indian markets are not about Japanese carry trade, because you've got three cross currencies. You're borrowing in Japanese yen. If you're a US investor, your home country bias is dollar, then you have the yen, and then you're investing in India. That's not how the Indian investments have worked. So I think to some extent, while the sentiment could have been weak, fundamentally we seem insulated from these Japanese carry trade problems, I think. In fact, I think we could be a beneficiary of some sorts, because the rate differential between the dollar and the rupee still maintains, fortunately for us.
Yeah, but the sentiment impact of if a yen carry trade unwind impacts NASDAQ in particular,
I read a note somewhere that said if you are not unhappy in May, there's no reason why you should be unhappy today, because the forex is exactly at the same level it was on the 4th of May that it was yesterday. The Japanese yen and dollar.
Okay, the Japanese yen dollar. I think the only thing to see is large infrastructure projects in India which are funded.
So that's about 5 or 7 companies that do that.
That's the limit of maybe impact. But so we are looking basically set for I think a bounce back in line with Asia today. The extent of it, of course, will have to be seen, but definitely a very quick recovery. And those SIPs, I mean, the fact that domestic investors come in, something that Chris Wood said yesterday as well, that money is waiting in the wings, it has to be deployed, and the kind of numbers, corporate results we've seen thus far have not been too disappointing.
No, not at all. And in fact, that's the trade setup for the day today, because we will see a bounce back, and I suspect it would well be a trending day today. So somehow I really doubt that it will be a pop-up, and that will be the stable level. So, because remember, while CBOE VIX came off from the highs yesterday, volatility is the nature of the game. We'll probably see a pop-up, and then maybe a trending day ahead if indeed the European markets support and come out shining well too. So that's one thing to keep in mind. Where would the bets be? I think almost everybody was in a unanimous view yesterday that the secure growth stories, you probably see the money where the money's gone in the past. You probably see defense names. You probably see the ones which were beaten on the most yesterday. Real estate and autos in particular might be the first ports of call. Metals is difficult to call simply because there is still you could argue maybe a global growth worry, and therefore I don't know if metals have as sharp a bounce, even though that was the index that was pummeled the most in trade. But autos and real estate, relatively much safer bets. Reliance had big shorts piled up yesterday. You could see a bit of a bounce there too. Just that, the pockets with maximum shorts. And I think at 8:30 we'll probably try and talk about that in detail too. But watch out for that. That's the nature of the beast. Remember, the bounce this morning at least is not looking as strong as the kind of fall that we had, and therefore it sets us up whether we have a trending day, whether we start off with a bit of a bounce and then we take it higher. Let's wait and watch if that were to happen.
Yeah,
Difficult to call.
We gave up almost 700 points yesterday, but recovering about 200. So what they call this usually is a dead cat bounce, right? So you may see a little bit of recovery, a little bit of short covering, but it's too naive and too early to say that we're done with this momentum cut that the markets witnessed yesterday. It's going to be grinding, it's going to test patience, and that's what markets are going to be all about for the next couple of days as well. That's what we have. We also have a bunch of earnings, and this morning the earnings is not bad at all. A couple of them that I have and that I've been tracking actually would do well. And also I think very quickly on this whole Bangladesh impact on trade that may impact a few companies, but I think from a more macro perspective, defense stocks could stand to gain significantly more this morning. As our borders become uncertain, Bangladesh, you have neighbors that may turn out to lead to some sort of uncertainty politically. And if that does happen, you will see stocks that play the defense piece. So your Zen Technologies, your PDL, HAL will only sentimentally stand to gain if that really happens. So I think that's one thing you want to keep an eye on over the next couple of days. And this is what a number of promoters and founders of defense company have told us. They've said, as your borders are unstable and unsecure, one thing you need to do as a country is invest in that.
But you traditionally for India,
and the way we are located now, it seems like.
So for India, Pakistan and China have
You've
been,
also got Sri Lanka.
Have been the issue. No, in terms of an actual threat, Pakistan only because it's funded by China, and China because it's that huge of an economic power. Bangladesh, from our perspective, I mean, Sheikh Hasina was seen as friendly to India.
But she's out now. That's
she's
the big
out
problem.
now. There is an army chief in. I mean, we'll have to wait and
it's
see.
a lot like what happened in Sri Lanka last year, right?
Yeah.
I mean, Sri Lanka debt is largely Chinese debt, but nevertheless, it could be, it could just be a theory. But it'd be interesting to see how these stocks actually play out in trade. But in terms of earnings, we've got a whole bunch of them that we are tracking. I'll start with Bharti Airtel. Good earnings. Brokerages also like what they've seen in terms of Bharti Airtel. Revenues were up 2.4%. EBITDA was up 1.8%. Margins have remained largely flat, so there's been no changes on the margin front for Bharti Airtel. Net profit is up about 128%. Now that is largely on back of an exceptional item that we've seen in the quarter. Mobile services ARPUs have also risen 1%, and there was that one-off interest waiver that was what impacted profitability in a big way. In terms of standouts in India, revenue for the first quarter of the financial year rose by 10%. Mobile revenues have increased 10%, driven by higher revenue per user and continued growth in customer base. Africa, while revenue in constant currency has seen an uptick of 19%, the devaluation of the local currency there is what's actually impacting margins and profitability of the African business. ARPUs have also improved in this quarter versus what we saw in the same quarter last year to 211 rupees versus 200 on back of good quality and high sort of revenue, high profitability customer base being added for Bharti Airtel. So all in all, good numbers. Dolat Capital and Citi both seem impressed. They've said they're largely in line and they like what they see with Bharti Airtel. Along with that, a few more to stand out in terms of earnings was Brigade Enterprise. Revenues were up 65%. We've seen them report their pre-sale numbers, and those have been phenomenal so far. Once again, a good quarter for Brigade Enterprise. Revenues up 65%. Net profit has gone up nearly 4x. Margins have improved marginally at 27.2 versus 26.8. And expenses have also grown by about 53% in this quarter for Brigade Enterprise. Now, what's the management has said in their release is that while the revenue number looks pretty healthy, they believe that because of elections and few auspicious dates in the previous quarter, their top line hasn't grown that significantly or as significantly as they would have liked. Real estate continues to be the standout. The revenue there came in at 707 crores. Leasing revenue fetched about 260 crores. Pre-sales also were up 10% in this quarter, and average realizations have also improved. So all in all, good quarter for Brigade Enterprise, and looking ahead as well on back of those pre-sale numbers, it seems like the performance of Brigade could continue and they would deliver quarter on quarter. Tata Chemicals, on the other hand, Another tough quarter, and we've been reporting on Tata Chemicals now for quite some time, and it doesn't seem to be ending in terms of the pain that this company is feeling. Revenues are down 10%, EBITDA is down 45%, margins have again crashed almost 9% to 15.1 versus 24.7. Profits are down nearly 70% for the quarter. Revenues came in lower due to lower realizations across various regions. Profits were impacted by lower soda ash prices and demand that continues to remain subdued. Earnings also impacted due to price cuts due to rising competition. So remember, for Tata Chemicals, soda ash is their biggest business. That continues to remain subdued. While there's a little bit of recovery in China, the demand for glass in Europe still remains muted in the US. So until that cycle doesn't start seeing a significant and sustainable recovery, Tata Chemicals will continue to be faced with disappointing earnings. The stock was already down 3% in trade yesterday. It'd be good to see what it does this morning. Maybe another rough start for Tata Chem.
Everything was down.
Yeah, actually, apart from ITC, Tata Consumer, those ones did okay.
Marico did okay, HUL did okay. Brigade also, good to see a company, real estate company whose stock has run up and has also got decent numbers, because the real estate pack and their results have been mixed, I would say, in most cases.
Yeah, just that one thing on Tata Chemicals, atrocious quarter, just that it's come exactly in line with estimates. The Bloomberg estimates to the T on net profit, 190 crores, 191 crores, and on the margins as well. I mean, 15.5 was the estimate, 15.1 is the delivery. So that's probably the only solace for a Tata Chemicals today, because otherwise the stock might be taken to the cleaners. But because it's in line with estimates on a day which is moving up higher, maybe the reaction could be a bit more. Bit less. Kinder is the word.
And I think one thing that may help is the intent of sort of cleaning up their balance sheet. They are looking at doing some debt repayment. So if that comes to the rescue, maybe it will work. But if just because your expectations are low and you deliver weak numbers doesn't mean you should be saved, right? If today's day of trade.
Yeah, today is also going to be, I would say, a bit strange in the sense you're coming off a massive sell-off. So you might have a rising tide, which helps even those who don't deserve it as much in that sense. ONGC could be one of those, because numbers are, I would say, its revenues are completely flat. At least EBITDA has beaten estimates in terms of expectations. There's a hit, of course, on margins and profits. The biggest reason is lower gas production and realizations, which have weighed on earnings, and this was in a sense expected. So let's look at the core numbers. Revenues are completely flat at 1.66 lakh crores. EBITDA is down 6%, but it's better than what was expected. EBITDA margins have also come off at 13.07%, and net profit down is 11%. So in terms of production performance for crude, it's down 1.4%, gas is down 4%, and realizations are also down. But in terms of that same point, that you are pretty much on what is expected, and if you have a bounce back, will an ONGC get some benefits of that? Will have to be seen. But I would say a mixed set of numbers overall. Same for Bharti Hexacom, actually, and revenues were okay, up 2%, EBITDA down flat. Margins have also come off from 47% to 45.8%. Net profit is up 129%, but there were exceptional items. The growth which you're seeing is led by smartphone additions, and there's an improvement in mix and in ARPUs. That is your revenue per user. Average revenue per user, that could be seen as a plus point. The total customer base, number of customers, has also gone up marginally. The average revenue per user number is important for this space. That's also gone up slightly. So that is really one to see. Their 4G customers have also gone up, and a fairly decent jump in the number of network towers. So I would say Bharti Hexacom is another one which has seen a bit of a mixed quarter. Deepak Nitrite, though, will be seen positively because you have a good set of Q1 numbers for Deepak Nitrite for the quarter. 47% up on operating profit, margins are up 240 basis points as well. Their phenolics segment has driven growth, and this is an important component as a starter sort of chemical for anything you want to make, from medication to paints. So that has seen good growth. Operational efficiencies have also led to an improvement in profit margins. The quarter-on-quarter numbers, though, are not looking as great, and that's something that investors might keep in mind. Those earnings are down because of lower other income, so not because of any operational issue. Meanwhile, there are two segments to look at. One is phenolics, like I mentioned, that grew 22.6%, while their advanced intermediaries grew at 1%. So I would say phenolics segment has moved things well for Deepak Nitrite. Others, of course, I'll come back with, and a whole host of those Bangladesh impact stocks, but why don't you?
Yeah, no, very quickly. Just a couple of names. One of them is Paka Limited, because in yesterday's session, the warrants and the shares allocation for Paka Limited came out. This is PAKKA, and SBI Mutual Fund and Carnelian Capital have gotten significant or have taken significant allocation both in shares and warrants of the company. I would suspect this should be viewed positively. So do watch out for Paka Limited in the session today. Could be a stock that could could do well in trade. So that's the first one. BEML, there is an EBITDA hit. Sales up 10% versus a guidance of 20 to 25%, and continues to be at an negative EBITDA margin and a PAT loss. So, and a stock which is expensive. The only point is it may correct a bit. I mean, I don't know if it bounces back because the market will take the tide higher, but it is done below what it had guided to, and which should probably come and hit the stock today. So that's the second one on my radar. And Schneider Electric is the third one, which could be an interesting one because the numbers were very strong. Revenues okay, but margin performance very strong, PAT performance much better, and therefore Schneider Electric could be another stock that could actually see some bit of green in the session today. So do keep an eye out for that one.
Right, that's of course a whole bunch of stocks that we will be tracking in today's day of trade. You've also got a whole bunch of earnings, the likes of a Shree Cement, Tata Power, Lupin, PB Fintech, PFC, Bajaj Electricals, but Bata India are some of the counters that will be reporting earnings. You've also got a brand new listing that will be debuting on the street. Akim's Drugs. Most people on the street were quite constructive on this one. Good valuations, good business. The response to the IPO was phenomenal, and the listing this morning will also be pretty solid. But amongst other earnings, Tamina, we've got a whole bunch of other ones. You want to start with those, and then we'll add to that list as we go along?
So just a couple that I wanted to talk about. One is Indigo, because of the notes out on it this morning. And I have a question for you, Samina. Delhi, Bombay, 18,000 rupees for more leg room. They're not quite calling it business class or first class. Would you pay that premium?
No, there's no way I'm paying that.
So that's their product. That's the product that they've launched yesterday, that MK and Citi have a view and a positive view on. Remember, Indigo is a market leader with a very hefty market share, 65-66%. They've unveiled their business class offering. They're calling it Indigo Stretch. And the first one is going to be the Mumbai-Delhi route, which is the busiest route, has a lion's share of all passenger flying in India by mid-November, so just in time for the festive season. Introductory prices at 18,000 rupees. You never know, with the way flight prices go up, this might actually be a good deal. And as a result, MK has set a target price of 5,300 for it, an upside of 25%. Citi has maintained a buy with a target price of 5,200. It will be launched first on 12 metro-to-metro routes. There's a whole host of, and I'll go through this quickly because my colleague Mahima will come in with a more detailed piece. But the Bangladesh piece, I just want to talk about it a bit. And there's been huge political upheaval over the last 24 hours in Bangladesh. Once again, highlighting what a stable democracy we are in an otherwise a very insecure kind of neighborhood. BEML was one stock Neeraj spoke about. They have exposure in Bangladesh. There's a whole host of FMCG companies that have a huge presence there. In fact, nearly half of Marico's international business, 44% of it, comes in from Bangladesh. Imami, Asian Paints, Pidilite, these are Jubilant has a subsidiary there. So there are a whole host of companies which could see some impact. Defense companies, like you said, have had orders to build in Bangladesh. Telecom companies also have presence there. So you could see some of that impact weighing down, because right now there's no clarity on whether the violence has been quelled and these businesses will be hit or not.
Indeed. And just to go back to earnings, we've got a few more. I don't know whether Neeraj, you covered V-Mart, but no, they've swung back into a profit. So this is going to be an important one to watch on trade today. They've also added more stores for the quarter. The numbers were good. Profit came in at 12 crores versus a loss of about 20 crores that we'd seen in the same quarter last year. Revenues have also seen a growth of 16%. So V-Mart could be one stock that could see some buying in today's day of trade on back of swinging back into a profit. Another one to the list of good earnings is BLS International. Profits were up 71% to come in at 121 crores versus 70 crores. Revenues have also grown 28.5% at 492 crores versus 383. So BLS, good earnings. V-Mart, strong numbers. Triveni Turbine, I know Neeraj has mentioned, again, strong earnings there. Motherson Sumi Wiring, profits have jumped 20%. Revenues have also grown 17%. So these are three more companies that will report or have reported good earnings, and the markets will be rewarding them and on the get-go this morning. But of course, the focus remains on D Street at large, whether or not you should be buying the dip, whether or not you should be using the dry powder that you've kept aside, anticipating a correction. From what we understand, Neeraj is standing by with more on that. Neeraj, is interesting. I spoke to a lot of people yesterday, and while people have been sitting on dry powder now, all the way back from October 2023, yesterday most people came out and allocated 10% at least of the dry powder that was sitting on the sidelines. So it does seem like every dip is getting bought into. Now, whether that's the case and whether that should be the case, please tell us.
Yep. So $1 million question, right? Buy the dip or stay put. Now, the key questions facing all investors, or Indian investors at least, will Indian markets again see the buy on dip? Will geopolitics coupled with recession fears outweigh India's growth promise and growth stability? And how deep can the yen carry trade impact be? Some of these are not answerable per se, but what we've tried to do is just get you some global opinion from the notes that have come out this morning. So Victor Schwetz of Macquarie has put out a note essentially summarizing what dangers are investors facing. He says that the sell-off was precipitated by confluence of events, potentially disruptive unwind of yen carry trade being one principal reason, perception that the Fed is behind the curve, investor concerns that the tech bubble is bursting, again goes back to the yen impact, and geopolitical adventurism. In his note, he says that when the West is seen this volatile, some economies or some authoritarian regimes might go on political adventurism. And that is something that he's characterized. Now, whether that leads to some more geopolitical tensions, who knows? But his point is that, he's asking whether does it require to join the stampede or create a buying opportunity, because yesterday's move he's called a stampede, and he says that although stampedes are inherently unpredictable, we view it closer to irrational, thus creating a buying opportunity rather than selling opportunities. So that's the first view that has come in. CLSA, which has wrote a note on Japanese equities, says that this was less a growth scare than a panic about the yen, specifically for Japan. And CLSA believes that Japanese equities are now might be bottoming out. And for back home, I'm just using this because Japan was the most impacted stock market. And Jeffries on India says that the risk is on the downside, given one of the longest streaks of a bull run. They maintain their defensive stance, and their preferred large cap laggards are private lenders, staples, L&T, and two-wheelers. So if you believe Jeffries, this is the nature of stocks you should buy. If you believe Macquarie's Victor Schwetz, maybe this is a buying opportunity. And if you believe a lot of people that you hear on NDTV Profit, then selectively go out and buy, because the views are still divided. Back to you guys.
Right, that's of course, now you need to take a call whether you want to buy the dip, stay put, but one way or the other, if you've got to create significant long-term wealth, staying in is probably the best one can do. It's not timing the market, remember it's time in the market, and that's what anybody who's created significant wealth will tell you. Implied Nifty is indicating to a good start, 200-point uptick after yesterday's big fall, so it's a sea of green this morning after global equity markets sold off substantially in trade. We'll take a break, we'll come back, we'll tell you where all the F&O action is. Yesterday, of course, we threatened the 20-day moving average, but this morning, the setup looks relatively better.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. This is India Market Open. Well, it was a very volatile day of trade yesterday, but can we expect short covering in the futures and options space today? Let's wait and watch. But how are Qs panning out? Now, yesterday was a day of trade where the Nifty came off by quite an extent. The underlying, in fact, well, dropped by as much as 2.7%, and we, at one point in time, were below the mark of 24,000. 24,000 at the moment becomes a crucial point, and sure enough, the Nifty will take support around there. Should we see strength earlier on in the session today, you never know, we could potentially see a bout of short covering too. Yesterday was a day where we saw unwinding to the tune of nearly 4% as far as the August futures are concerned. Moving on to the Bank Nifty, this is where we actually saw fresh shorts building in. We do know that this particular index has so far been a lot weaker as compared to the Nifty, and it's well off its life highs at the moment. This one also tested 50,000, this big round number yesterday as well, but it closed above that, and that perhaps is something where bulls could potentially take solace from. Now, as we move into the options market and talk about how things are faring there, perhaps unexpected lines, a lot of writing around higher level calls, and still just look at the kind of traction that we've seen around the 24,000 put. The most amount of open interest, which means that it certainly will, throw up some amount of support, some amount of resistance as well towards the downside as far as 24,000 is concerned as well. Moving on to Fin Nifty, again, it's going to be a tough one to call. We've seen expansion in option premium, so it's always a positive, especially given traders in general like to sell, this particular Fin Nifty expiry. But moving on in terms of stocks, naturally it was a day of trade where we saw a lot of red. Dr. Lal Pathlabs, Samadhan, Motherson, PI Industries, Canfin Homes, all of them looking at shorts. Among stocks which saw unwinding, well, there was only long unwinding largely. Birlasoft, India Mart, Granules, Chambal Fertilizers and MCX. But the question really is that can we expect a short covering today? Well, let's get an expert here. We have Amit Goel of Amit Ventures who's joining us on the show. Amit, morning. Thank you so much for joining in. Well, let's start off with your view on the Bank Nifty, because that clearly is taking everyone by a little bit of surprise here. But I believe you have a contrarian view. How are you looking at things here?
Hi, good morning, Agam, and thank you for having me again. And very good morning to all your viewers. Yes, I do have a contrarian bullish view on Bank Nifty, simply because I feel that whatever fall that we have witnessed in the last few trading sessions has probably, the time has come for it to cool off or something. The global cues also point to us in that direction, especially if you look at Nikkei, the way it has bounced back yesterday with a 9% up move today. Even the futures in the US market show that we are probably looking for a positive open today. Since why I'm referring to the global cues so much is because the fall also has been pretty much led by the global cues and not really the domestic parameters. So I'm trying to play the contrarian view here in Bank Nifty simply because I do see a support building up at 50,000 levels. If you notice the option chain also, the 50,000 put has a lot of strength over there. And yesterday the way it was defended points me towards this fact. Now, the kind of view that I want to play out is slightly different. I would start with an intraday view, wherein we would, at about 10 o'clock, once the market settles, and if the Bank Nifty spot ranges between 50 and 50,200, we would start with selling the 28th August expiry 50,000 put. It's a naked put, mind you. But since it's in the intraday, and once the market is settled, we start with that. We will have a spot SL at 49,500. Suppose the market falls below, and by that time we would probably make a loss of about 5,000. But if the trade works out in our favor and we do see a bout of short covering and there is a rally in Bank Nifty, we could hold on to this position to extract the maximum gain of about 14,000. But if traders want to hold on to it overnight, and if they are in profits only, they could consider buying the 49,000 put as an hedge and convert this naked put on an overnight basis into a bull put spread, which is a bullish trade.
So an interesting strategy, and to remind our viewers, under no circumstances, if you are new in this market, should you be able to take an overnight position without buying the recommended, outlier, as well as Amit has mentioned. In this case, of course, it will be the 49,000 put, because it becomes an extremely risky bet to carry on a naked short overnight. That said, at the moment, though, it's a fairly simple and straightforward strategy that Amit is looking to play on an intraday basis. And with that, that's how he's looking at the Bank Nifty. And it does seem like we could potentially see a good day of trade as far as the benchmarks are concerned, given the kind of volatility and relative stability when it comes to global markets, at least for today. But that said, Amit, let's move on and talk about LTI Mindtree as well. Why is that one on your radar?
So I was looking at the price action. Obviously, if you look at the most of the F&O stocks, we would see a very strong downward move. Creating fresh shorts here probably does not offer me a great risk to reward on a higher time basis. So I was looking at possible reversal candidates. And interestingly, when I noticed LTIM's price action, it was what you would term as a bullish Morubozu candle, wherein the open and low were the same and it closed near the top. While it was still a negative close of about 2%, I still feel that given the price action at the lower levels, there is some strength building up here. This is again a contra view, simply because the market has fallen so much, I do not have a great risk to reward on the downside. So I'm trying to play on the upside. Here the trade is very simple. It's a simple bull call spread, wherein we will buy the 29th August expiries 5,400 call and sell the 29th August expiry 5,500 call. which is basically a bull call spread, and we will play for the upside. We will keep a rupee stop loss of about 3,500 since the strategy is a debit spread and we lose on account of time decay. The maximum profit on this trade is likely to be about 8,500 if we, if the counter moves in our favor and sustains that move. The maximum, the margin required is about 35,000. The trade logic is simple, that we see a price reversal in terms of the candlestick pattern, which is known as the Morubozu, and also the global cues again seems to support this view, especially with Nasdaq futures trading upwards of about nearly 2% in the morning. Thanks.
All right. Well, so a simple, straightforward bull call spread where you're in fact buying a 5,400 call, and against that you're selling a 5,500 call, playing LTI Mindtree for the upside with a maximum profit potential of around 8,500 rupees per contract. But on that note, Amit, taking a moment to thank you for joining us and taking us through your views in the markets, and of course helping us with a handful of option strategies that we can work around with. With that, it's back to you.
Thank you for that. Another big story really, and what's been happening is what's happening in Bangladesh, where Sheikh Hasina had to be airlifted in a chopper. She was brought to the Hindan base in India, and there are reports now that she could be going to London. Protesters actually broke into her residence and she had a threat to her life. Now, while there is political uncertainty in Bangladesh, and we've been talking all of this time on the impact of the Japanese yen on India, the fact is that the neighborhood matters more because of the extent of investment Indian companies have made in Bangladesh. In fact, Mahima, with the help of all her colleagues in the research team, has put together this pretty extensive list on how much skin in the game we have when it comes to Bangladesh. Yes, Mahima?
Right, Tamanna. So a lot of companies have a significant presence in Bangladesh. I'll break it down for the viewers sector-wise. From the FMCG pack, we have Marico, where 11% of the total revenue comes from Bangladesh and 44% of the total international revenue comes from Bangladesh. They've said that by FY27, this 44% will go down to 40%. Imami also has a wholly owned subsidiary in Bangladesh, and FY24 around 17,400 revenue. So 6% of the revenue for Imami comes from Bangladesh overall. For Asian Paints also, it has a wholly owned subsidiary where they have around 10 crore of revenue in FY24 that came from Bangladesh, 12 crore of royalty came from Bangladesh, and they have a 12 crore loan also from the Standard Chartered Bank of Bangladesh. Now, Pidilite has two subsidiaries in Bangladesh. The first subsidiary, which is a specialty chemical limited, around 4.23% of the contribution in FY24 came from that particular subsidiary. Moving on, Jubilant Foodwork had recently completed full acquisition of Domino's in Bangladesh. They hold around 26 stores in Bangladesh overall. Godrej Consumer also has a wholly owned subsidiary in Bangladesh. Now, VIP Industry, this is an interesting one where 30 to 35% of their capacity is sourced from Bangladesh. So this could be one of the company that could get impacted. Now, a bunch of railway companies also have significant presence in Bangladesh. RITES has a contract supply of 200 broad gauge coaches, around 906 crore is the value. For Texmaco also, they export freight cars to Bangladesh. And for defense companies, Garden Reach total contract of $16.5 million was a contract that is there with Bangladesh. Now, oil companies, a lot of oil companies like Indian Oil companies export sulfur. Telecom companies also has significant, Airtel also has significant presence, and Sun Pharma, and a power company like Adani Power's subsidiary has 100% of the power generated is sourced to Bangladesh. So all of these companies could see impact because of the crisis that Bangladesh is facing right now.
Thank you for that, Mahima. This is, of course, going to have a long-drawn impact in terms of trade. But remember, in terms of India's trading partners, Bangladesh is the top 25. It used to hold position number 4. Now it's 5. In FY24, the trade or the exports to Bangladesh have already declined 10% in the year behind us, but nevertheless significant and will have impact sentimentally, at least on some of these companies that Mahima highlighted for us. Well, we're gearing up for trade, and it's going to be a morning where it'll be interesting to see whether new fresh longs come in, or of course it's going to be on the Nifty or stock specific. Rajat Bose, Sunny Agarwal both joining in with a technical and a fundamental view. Rajat, I'll start with you on the charts. After yesterday's big fall, today comes as no surprise where we should get a dead cat bounce in trade. If we do get a gap up of 200 points on the Nifty, intraday, do you think it's going to be 200-point gap up and then we build on those gains, or that would get sold into, in your opinion?
Yeah, I would say that there is a possibility of a gap up opening, and then we need to see how things pan out. But the fact that the VIX rose by 42.23% in a single trading session, even on June 4, it went up by only 27%. So this is the VIX rising in such a manner is definitely something to worry about. But if you are talking about a dead cat bounce, then I would say yes, because the place where this whole crisis originated, I'm not talking about Bangladesh, that maybe a stock-specific impact will happen. But if you look at the two key indices today, as they are trading now, that is Nikkei and Hang Seng, Nikkei has given a bounce, but the problem is that in Nikkei there is a death cross. When I say death cross, it means the gradients of the two moving averages are sharply down, and the shorter term 20-day moving average is piercing the 50-day moving average there. So even if you see a bounce there, even there it would fall. And the S&P 500 also did not show much of, it is almost trying to test its 200 exponential moving average. And since we are highly linked with all these, through the FIIs putting in money here, so as you said, a dead cat bounce can happen, and at higher levels you can expect some selling. And what used to happen earlier, that may not be the case this time. That is, one day fall and immediately a rise, that may not happen. This fall may continue after a dead cat bounce. And the three levels to watch out for will be 23,900, 24,000 to about 23,900 will be a very important level. After that, it can slide down. If that gets taken out, then there could be a fall to something like 23,800, and thereafter 23,500 will be a major support area. Regarding the Bank Nifty, yes, Bank Nifty is not as much weak as the Nifty, but even Bank Nifty has got some problem in the sense that it needs to take out 50,100 mark. If that level is taken out decisively, thereafter there will be another level to watch out for, and that would be a major key resistance level. Now earlier that was a support, that is 50,400. If 50,400 can be taken out by the Bank Nifty, then you will see that the Bank is giving a bounce.
Rajat, if anybody initiated fresh longs on the Nifty yesterday before closing, would you advise them to exit those longs in opening this morning, or hold the position till closing today?
I would say that, had somebody initiated a long position in the Nifty at the day's low yesterday, then you have some cushion. And as I said, if 24,000 gets taken out on the downside, then it would be better for that person to actually exit. Otherwise, I would say that one can stay put with a stop below 23,897.
Sunny, good morning to you. Great to have you on as well on what is an important day. The question is that when there is sort of a pullback after a harsh day, what do you bet on? Is it going to be those spaces which got hurt the most? So, for example, real estate was one of those, your defense, PSUs, etc. Or are you going to stick to the safe bets or the pharma and consumption stories of the world?
Yeah, good morning, everyone. I think one should stick to the companies where we have seen a very good set of earning growth during the June quarter, and outlook is pretty good. A case in point, companies like Amber Enterprises, Indian Hotel, Zomato, Just Dial, Natco Pharma, Amara Raja Battery. I think ultimately these are those companies which will find a lot of institution interest on every dip. So maybe a gradual deployment is the right strategy. I don't know at what levels the Nifty will stabilize. But ultimately, what I believe is that companies which are likely to deliver healthy earning growth over the next 3 to 4 quarters, they are the first companies where we will see a lot of institution and HNI retail buying emerging at a lower levels. Among the large cap, few good names, which few companies which we like are among the defensive name is ITC. I think HPCL is one of the company which we like among the ONC space. We have seen a decent correction in the crude oil prices also, and at the same time, with their Pharma refinery going on stream in next 1.5 years, I think the company has potential to deliver close to 30 to 40,000 crore EBITDA 2 years down the line, trading at 80,000 crore market cap. I think it's a pretty good risk reward ratio. ICICI Bank among the bank, I think a very a good kind of a trajectory where we will see a 13 to 14 kind of percent advances growth. So I think a few mix of few large cap and decent mid-size name can be added gradually over the period of next 2 to 3 months.
Right. Rajat, what are you doing with oil and gas stocks with crude at a 6-month low? I'd imagine HPCL, BPCL, IOC could extend in today's trade. Could they be good trades today? Rajat, what would you do with oil and gas stocks in early trade on back of crude weakness?
Well, regarding say IOC, what I would say is that you can, don't get into a long position in all of the three. But if you say you want to play IOC because it has given a hammerline formation, that means that the last 4 days of fall is likely to be arrested, and unless yesterday's low, which is 166.99, roughly 167, if that is not taken out decisively, then you will see a bounce back here. But unless it crosses 183 to about 185 range, you cannot expect much of a rise. But at lower levels, IOC or say HPCL, BPCL, you can take positions. But when you are taking positions here, since they have built up a base in the recent past, you should be taking it for the medium term. When I say medium term, I would say that 6 months plus kind of time horizon.
Okay. Well, Sunny, we'll take a moment to thank you because I understand we have to let you go, but really appreciate you joining in for this very quick perspective. Appreciate your time. Rajat, stay on. Lots more to talk. We'll take a quick break, come back with more.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hand.
Back with India Market Open right here on NDTV Profit. Let's get the implied open up on the screen. It's a day of bounce because Asia is a sea of green, by the way. And don't look at Nikkei. I mean, that's an outlier, but other markets too are not doing too badly. China may be a bit soft, but the rest of the Asian markets are not doing too badly. So that's the first piece. Now, with that in mind, what are the stocks that you should keep an eye out for? By the way, keep in mind the US futures are also trading much better right now. So that's the other thing that you got to keep in mind, that the mother market is trading with a tick of green. Rajat, you responded to Samina's question that you will see what to do once the markets start off higher for yesterday's longs. But I'm asking you, what are the stocks that you would trade this morning afresh at the prices that we'll see at 908 or 915?
Well, I have already chosen my stocks, and they are two stocks where I'm going to suggest going long. The two stocks, despite the fact that there is some problem in Bangladesh, but I feel that Asian Paints is not very heavily dependent on its Bangladesh operations. And even if it were, since I'm giving a short to medium term call, there would not be much of a problem. And because there is blood on the streets, this is the time when you buy stocks of this kind. I would give two targets, medium-term targets of 32.45 and 3400 for Asian Paints, and the stop loss should be placed below 29.80 on a closing price basis. 113 point stop loss banta hai for a medium-term trade in Asian Paints. This stock is actually showing a saucer formation. The base building is already through. It is one of those stocks that actually showed some green tick yesterday. And the other stock that I like is Adani Wilmar. I like this stock hell of a lot, although I do not have a personal position, because each time I wanted a personal position, I actually find that I've already given recommendation to my clients. So SEBI norms doesn't permit me to take position in this. But Adani Wilmar has a flat base formation, and from there it is going up and heavy volumes. So Adani Wilmar has much less risk, but it has got much higher potential. The targets are 411, 434 and 459, and I would suggest a stop loss below 357. It closed yesterday at 382. This is a stock that you hold. You are definitely going to make money over the medium to long term. This stock looks really very good. And I have no predilection that I am talking on a channel that is owned by the same group.
Okay. Point well noted. Watch out for Adani Wilmar, by the way. The shifting of the FMCG business from the Adani Group into Adani Wilmar strengthens that too. By the way, standard disclosure, Adani Group owns NDTV Profit, and you're watching NDTV Profit. So just make that disclaimer while we speak about some of these group stocks. But it's the market at large which deserves attention. Rahul Arora, CEO of Nirmal Bang Institutional Equities, joins in. Rahul, good morning. Thanks for joining in. I remember our conversation when we nudged that circa 25,000 mark. You were a bit skittish then. The markets have come off a little bit for reasons which may have been different from your reasons. Be that as it may, we are 4% lower, and we may see a bit of a bounce today because the global markets are doing okay. What is your house's central message to clients this morning for Indian markets?
Good morning, Neeraj. Thank you for having me on the show. So I think, Neeraj, if there's one thing that the markets have taught us over the last months, is that every time you get such a large dip, and the two most recent ones being the union budget and the central election results, they're being very easily bought into. And, it just goes back to the same conversation that we keep having in terms of the liquidity that's there in the market of, about 1.5, 2 lakh crores of cash on the sidelines, and the kind of pressure that fund managers are in, given their CTCs are locked into their own funds, that, if you get a dip like the kind that you got yesterday or on the 4th of June or on the budget, you don't want to wait for it to go much lower. And therefore, you see a lot of follow-up buying that's coming in through the next day. I still think this is just a minor blip. I still don't think valuations have aligned themselves to what the earnings potential or the earnings outlook of India is. I think, the earnings outlook is not that strong, basis what we've seen in the ongoing earnings season as well, which is the first quarter of the fiscal. Ideally, it would have been nice if you could have had a 10-15% healthy correction and you would have stocks that were down about 25, 30, 35%. But I think at least, Neeraj, the one good part is that a lot of the market that was seeing excesses, that's where the valuations are coming off also in a material fashion, whether it's autos, defense, capital goods, EMS players, consumer durables and electricals. I think that's where you're seeing the maximum pullback, chemicals. So that's a bit heartening to see that where the excesses were there, they're pulled back. But I still think that, we really can't call this a correction, Neeraj. I mean, it's as you very rightly pointed out, it's only 4% at a 25,000 Nifty. For it to make a meaningful dent, it would need to be 10-15%. But I think this might be very easily bought into is my sense.
Rahul, does that mean if you're an investor who's been sitting on some dry powder or cash, now may not be the best time to add incrementally to the markets, or would you start adding incrementally at these levels?
No, so I think, Samina, the point is, what could make the market fall from here? I mean, you survived 2 wars, you survived a 5% inflation, you got a bit of a hiccup on the election day, you had the increase in capital gains taxes, and yet you're at a 25,000 Nifty. Now, obviously, what we saw yesterday is not the end of the phenomena as we know it, because I think if you get into a situation where the US cuts rates, you will continue to see this carry trade unwinding. But the point is, where does India figure in all this? The point here is if India manages to hold on to its interest rates, it may actually become a positive beneficiary of this carry trade unwinding that's taking place between the US and Japan. And that could actually cause foreign flows to still come in. So like I was telling Neeraj, I don't think that there is a material case for a downside, even on this news flow. Even if you fall another 2, 3, 4% from here, it's not a bad time to start deploying incremental capital. Not necessarily on the manufacturing, defense, and automotive side, but I think there is still some pockets of the market that are starting to show value. But I would use yesterday's lows to start nibbling in a little bit and average on the way down.
Rahul, good morning. Tamanna here as well. When you're saying nibbling in a little bit, are financials looking exciting? Because through our conversations yesterday, even when the market was looking like it's in a tough spot, the commentary coming in was that financials are actually now well poised from an Indian perspective. So what are your favorites there?
So I think, Tamanna, you're absolutely right. I think the only pocket of the market that's exuding value at an aggregate level has been BFSI. The market's been waiting for this sector to rally in a material way, but that's not happening in a very aggressive way. Yes, HDFC Bank has pulled on from the lows that it hit earlier this year by about 20-25%. But I think valuations are still not out of whack. I think if you look at, say, an ICICI Bank, that's probably the most expensive banking stock in India today at about 2.5 times. Axis would be shy of that. IndusInd would be at about 1.5. And the elephant in the room on the public sector side, which is State Bank of India, would probably be trading at about 1.6 times. Yes, there is still a fight for incremental deposits, and you're seeing, marginal deposit rates rising, and you're therefore going to see a little bit of pressure on net interest margins. But I think progressively, as you look at the back end of this year, say, the Jan to March quarter, that the RBI was to go in for a rate cut, I think that you might see if people are looking at banks as a 1 to 2 year investment, this might be the best place to buy. Apart from some of the names that I listed, I think even from the mid-cap space, if you look at Federal Bank, now that a change of guard has been announced and the market has liked it, that looks like an interesting play. And let's not forget, the first order that the Prime Minister signed after resuming office for the third time was a housing order. So I think housing finance companies could also be interesting. We like names like Aviation and Home First Finance. And lastly, I think insurance, again, a pocket of the market that really hasn't done too much. ICICI Pru Life, in terms of stock price performance, has been one of the best results this quarter. Obviously, buoyed by ULIPs across the board, but I think what they're trying to do on the protection side of the business, there is some value there. So, I mean, these are some stocks in the overall BFSI space that we like, but it is clearly, without a second thought, the most overweight sector at our broking house at this point.
Wow. Okay. Most overweight sector. And that is life insurance. So very interesting. We'll take views from Rajat Bose on some of these insurance companies as well. But a good time as the pre-open rates are just settling down. Good time to get in, Anushi, with a list of some of the stocks that should be kept on your radar. Anushi.
Hey, morning Neeraj. So I'll start off with the earnings list first. Now the first one on the list is Tata Chemicals. So overall, if we see on the first glance, a weak set of numbers, but the numbers were majorly in line. So if you see the revenue, that was about 10% down, while the EBITDA was about 45% down. But do note that the revenue was down due to the lower realization across the regions, while the profits were impacted by lower soda ash prices and subdued demand over here. Again, the earnings impact that we are seeing is due to price cuts in November amid the rising competition scenario. But the company does expect to record a 400 crore of incredible EBITDA by FY26, so that remains on a watch out for. Margins, if we see, they have also narrowed down to 15% of range as compared to 24%, 7%. So this is on Tata Chemicals. But moving on to Triveni Turbine over here, good set of numbers, 23% of revenue growth, while EBITDA saw about a 34% jump and margins inched upwards to 20.5% as compared to 18.9%. So if you have to look at over here, the revenue growth was led by the domestic sales, which increased by 27%, while the export sales increased by about 19%. The company also saw an order booking of about 636 crore in the quarter, which took the order book value to about 1,726 crore. So moving next to Motherson Sumi, now in the Q1, the company reported a 16.7% of growth at 2,185 crore, which was in line with the Bloomberg estimate of 2,184 crore. Well, EBITDA saw about a 15% growth and margins were net in line at 10.9% versus the 11.1% last year. If we are to see the key highlights for this company, also the revenue growth was supported by the increasing volumes, and we see the revenue growth sustaining despite the higher raw material costs that the company has been seeing, along with the startup costs which are mitigated by the operational efficiencies. And the last one on the list is Deepak Nitrite, which saw about a 23% revenue growth, while the 47% growth in its EBITDA. Margins were at 14% as compared to 11.9%. And over here, advanced intermediaries saw about a 1% growth, while the phenolics segment saw about a 6.26% growth. So these are the four stocks which were in focus today and will remain in focus.
Okay, so it's going to be a bit about results as well, and you're seeing that in how the pre-open session has panned out. It's closed about 0.5% up on Nifty. BLS International, Brokerage, Schneider Electric, some of the winners there, and all on the back of the kind of results they've come in with. A quick word from Rahul Arora before we get the top brokerages of the day. Rahul, do you think that that's really the theme, that you're going to get that investor love or trader love if you've performed on your corporate numbers, and no easy way out there?
I think that's right, Tamanna. I think if you look at this result season, it's told you that, right? I think any stock that has done well, including large cap names and including the fourth quarter results that we saw in April, May, they've been rewarded with a 5 to 15% upside. And conversely, for anything that's missed, it's been punished with a 5 to 15% downside, regardless of it being market cap oriented. So I think it is going to be very stock specific. Like I was saying a little earlier, barring BFSI, it's a little difficult to take an overall top-down view on any sector right now. You'd have to be very stock specific. But I think, the issue, Tamanna, is we've been analyzing upgrades to downgrades at our broking house at the end of every quarter. And if I was to broadly look at, say, the last 4 quarters average, you would still see at the end of every result season, by and large, 55 to 60% stocks getting downgraded and just about 40-45% getting upgraded. So I think we're still in that cycle where we haven't gotten into an aggregate earnings upgrade cycle, and which is what is going to make stock selection at these valuations a little more challenging. That being said, there will always be stocks cheap at a 25,000 Nifty also, and there'll be stocks expensive at an 8,000 Nifty as well. We just need to find those. But as you rightly pointed out, I think most of the triggers, barring the US election that's slated in 3 months, are pretty much out of the way. So I think it's by and large going to be centered around central bank action and earnings from here.
Central bank action and earnings from here, both of them, of course, keeping market participants on the edge. But Harsh is standing by with what brokerages have to say. There's, I believe, a note from Citi and Emkay and Interglobe Aviation. Harsh, so over to you.
Well, yes, 18th anniversary of Interglobe Aviation, and on the back of that, they've announced a few new premium offerings for customers. First off, they are going to offer business class a business class option for customers on domestic flights. What they're going to start doing is branding this as Indigo Stretch, and they've basically premiumized a business class offering for the Indian customer. Route to first start off between Bombay and Delhi, and an introductory price of 18,000 rupees has been announced for this. It's going to start mid-November, so that's first. Second, they're going to start reward points on their recurring customers as well, for their recurring customers, and they're going to be non-expiring points. So a couple of benefits coming through on that front as well. Interglobe Aviation already having a market share of roughly 61% in the Indian market. Citi continues to be quite bullish. They believe valuations seem to be favorable. They've in fact added a 10% premium to the 5-year EV to market cap valuation that Interglobe Aviation has. 2.6 times is what they're ascribing. MK2 bullish on it. 25% upside is what MK sees on this one.
All right. Sorry for rushing you there, but we're nearly a minute away from market open. Rajat, very quick view on Interglobe Aviation.
It is hitting its support area, and now today it has shown a 4,300 pre-open tick. So if it were to cross 4,500, then there would be a lot of gumption. Otherwise, it will remain range bound between 4,300, say 4,300 on the downside and 4,600 on the upside.
Okay, watch out for that, and we are close to market open. The one stock that I would really love to get a view on post market open is Zomato, the winner of Friday, one which lost the least yesterday, so to say, and is up again today. So we talk about consumption names and stocks which are in a frenzy. Zomato features in that list for sure, up about 2.5 or 3% as we speak in today's session too. So that's to be kept an eye out for. A big large cap name, by the way, Zomato is. But here come the first trades this morning, and a bounce for sure. The extent of the bounce is the question, and do we sustain that in the first 1 hour is the big question as well. So we'll start off in the green on expected lines. Nothing rah-rah about this. This is about 227 odd points, less than 1% up move, or just about 1% up move. The banks participating as well. Wonder if IT, which was a big loser in trade yesterday, is that participating, up about 1% too. So largely in line with what the other indices are, and metals should be the other one that you should keep a keen eye out for. Mid caps 1.74% higher. Small caps, I reckon, should come up on your screen, maybe between 1% to 2% higher for Nifty small cap as well. Get the heat map up on the screen. Mid caps and small caps are doing really well. Large caps too not far behind. Yesterday's winners are today's losers. SBI Life, Cipla, Apollo, HUL on expected lines. The low beta ones sulking in trade. What's doing well? ONGC, a bit of an uptick. Remember, the stock was down 6% yesterday. Tata Motors was the top loser. I don't see it. Oh yes, I do see it. It's the top of the pile, 3.5%. Adani Ports, 3% higher. Effectively, the template seems to be that the ones which were beaten on the most yesterday are the ones which are climbing the most. Let's see if this lasts. As we speak, 1.25% higher. It's not looking bad at the start. Tamanna, let's see if this sustains.
I wouldn't call it a complete recovery, but it started positively, and even in the broader markets, you're seeing a very clear pattern about specific responses as per what the quarterly numbers are. And remember, in the middle of everything that's happening globally, we do have our result season on, and that's become a big factor as well. So let's start with some of those. Let me pull up Brigade, BLS, some of those who've had numbers out. Triveni, Turbine, Schneider, for example, all of them with numbers which beat street expectations. In a sense, you've seen that with ONGC as well. You did have a slide back on profitability, but the EBITDA was in line with what was expected. And likewise, Brigade actually surprised on the positive. BLS BLS on the positive as well. Both stocks about 6% up right now. Let me also look at some of those others. Triveni Turbine, Schneider have seen a good set of numbers. Let's pull up Bharti Hexacom. Look at Schneider up 9%. If you'd watched our stocks to watch list this morning, Neeraj spoke about Schneider Electric. Triveni is also something that we covered. Bharti Hexacom has seen a good view from JP Morgan. They've remained overweight and set a target price of 1,280. That stock is up this morning. We've been talking a lot about Indigo's business class launch. Two positive brokerage notes, about 2% up on that stock. I'll just pull up an Angel one as well. Their business update has come for the last month, and their client acquisition has gone up 85% year on year in the month of July. So all of this has worked out. Like I said, it's largely positive. I wouldn't say a runaway up move to make up for yesterday's losses, but definitely on opening, the sentiment is positive.
The broader market's also doing pretty much what the benchmark is. So the Nifty 500 is eking out gains this morning. It is largely performing better than the benchmark. The small cap index up 2%, the micro cap index and the mid cap index all trading with gains of nearly 2%. Stock of the morning has to be Zomato. So no apparent reason, but the stock post its earnings has been on a tear. Another 6% being added on Zomato on extremely healthy volumes. Now this is what you call a shining star. We did talk to Karan Turani just before the weekend on Friday, and he did say that his target and the whole host of target prices for brokerages range anywhere from 300 all the way going up to 370 rupees. So very, very constructive on Zomato. It's up about 120 rupees in one quarter itself, and 270 now on the day that the markets are just about finding their feet after yesterday's sell-off. PFC and REC, both those counters have some exposure in terms of borrowing in the Japanese yen. The market might have punished them yesterday, but this morning there's some more sanity returning to the street. PFC and REC both doing well in trade this morning. Cera Sanitary is having a pleasant morning, 7.5% higher. Again, good volumes on that counter too. The stock is trading healthy. BLS International, I think Tamanna mentioned that, and Triveni Turbine, those are both earnings reaction, and both those counters trading with solid gains. Lux Industries is up and about 5% higher in trade. Samvardhan Motherson Wiring, another company that reported numbers beat street expectation. The stock gets a thumbs up, 5.5% higher in trade is what we have. Brigade, along with it, it's taking the whole real estate back higher. So Brigade is of course reacting to earnings. Let's take a look at VMart as well. They've turned into profits, turned into black this quarter after 12% on VMart. So that turns out to be a top gaining stock this morning. It's reported a strong profit of about 12 crores versus a loss of 20 crores this company had seen in the same quarter last year. So on back of that, you're seeing a big move coming in on VMart this morning. Tata Motors is looking good. Welspun Corp is having a good day. Nuvama Wealth is up 4%. Railway counters are looking strong. Inox Wind is up 4%. Yes Bank, so mid-cap banking names are also looking fairly good in early trade this morning. A quick check on what's on the sell side, and it's a handful of counters. So off the Nifty 500, you've only got 6 to 7 counters that are trading subdued. The rest of the market trades with the positive bias. Gokuldas Exports is also up 8%. On the sell side, Sirma on back of earnings is down 4.5%. Marico maybe on the Bangladesh impact is trading with a cut of 3.5%. Arkian has had a very strong run last week. Some profit taking this morning, maybe because chemicals aren't seeing the light of the day just yet. Arkian is also trading with a 2% cut. But apart from that, nothing else looks weak this morning. Rahul, you want to comment on this one? Anything that's defensive facing, consumption facing, more India-centric, domestic themes, could those be sectors one could add incremental allocations to, in your opinion? Or for now, it's best to just stay put and not add anything more to these sectors at least?
So I think, Samina, the way to play domestic consumption, sorry to sound like a bit of a broken record here, but it'll probably be through banks. And I'll tell you why. Because I think if you look at, let's say, FMCG, since you pointed consumption, most FMCG stocks since the fourth quarter's results till now are up between 25 to 35%. Save ITC, which is probably trading at about 27, 28 times. The rest of the consumption pack in India trades anywhere between 45 to 60 times. Now, if you look at the results season gone by, barring Britannia and Tata Consumer, which reported volume growths of about 8 and 10% respectively, though Tata Consumer's beverage volume growth was zero, the others are still at about, that 2 to 5%. So I'm not really sure if I want to be paying those kind of valuations for these kind of volume growths just yet. Consumer discretionary could be interesting from the point of view of hotels and aviation. But, it gets me a little concerned that low-cost airlines are now trying to become full-service airlines. In the past, we've had instances like Jet Airways and Kingfisher where the markets have not really taken too kindly to such kind of moves. So, profitability is one of the key reasons that Indigo got its valuations. But I think the hotel sector in India is doing remarkably well. And I heard you guys talking about Zomato. It was actually one of my biggest calls, when the stock was at 45, it was literally a sitting duck at that point. Stock's up dramatically since then, about 6x. But I think this could go a very similar way to Westlife, because I think there was a very long period where Westlife was a loss-making company. It realigned its focus to cash flows and return ratios, and subsequently got re-rated multiple times over. So that could be an interesting play, because I think even if you look at insurance, to go back to where we started, there's a lot of interest coming in Policy Bazaar. So people are saying, should we just buy the aggregator instead of buying individual stocks and try and take the benefits? So I think these would be some ways that I could probably look at playing consumer discretionary, but consumer staples, by and large, I think at this point, I'd stay away. Maybe you could throw in an Alcobev. We like the beer sector, so we're fairly positive on United Breweries at that as well.
It's interesting, Rahul. We were just, thinking. We were thinking about your view on Zomato, and it's interesting you came in with Zomato. Just want to understand that in that consumption space or discretionary consumption space, what is the next bet like a Zomato? Do you see any merit in a delivery? Would you wait to see what Swiggy does when it comes in?
At these valuations, there is no next Zomato, to be very honest. I think, at 40, you remember at the peak of the lockdown, Indian hotels had dropped down to 60, Inox had dropped down to 180, 200. I mean, these were sitting ducks at that point. And, anyone knew that these were going to be multi-baggers. Obviously, Swiggy, when it comes in, will reference its valuations from Zomato, and it'll get a listing pop. And generally things, you do see a sway in investor sentiment for the short term. We saw that when Burger King listed as the only direct competitor to McDonald's. But I think eventually the incumbent, sort of gets its mojo back. If I take you back years and years back, I think this has happened with Maruti when, foreign players came in and, the Maruti stock price suffered. But then look at where the market share sits today after all these years, and everyone coming in, it's still sitting at 50% plus or there and thereabouts. So I think it's a little difficult to take a call on consumer discretionary overall, but I still think, Tamanna, on a relative basis, hotels, and I say this not just business hotels, but even luxury hotels with foreign tourism sort of picking up. I think that could be probably one space where you could still see the best returns from a consumer discretionary sector standpoint.
Okay. Well, about 1% higher. Nifty IT is leading the way. The one which was pummeled the most yesterday has bounced back the most. So that's to be kept in mind. But yep, Zomato, Schneider Electric on results is doing well. G Shipping has bounced back too. Rajat Bose, your initial thoughts, the way the bounce back is happening. Are you liking the mood, and are you buying into something on open? Or are you recommending somebody buy something on open?
As you were discussing consumption space, over the short to medium term, Zomato might move up from here. Once it crosses 285 decisively, after that, there would be a further upside, say something like 310 to about 325 level. Disclosure has it that I am a shareholder in Zomato. Zomato, in my view, is actually getting more prop because of Blinkit. Blinkit's performance is really very, very encouraging. So that way, Zomato is going to go up. United Spirits, another stock I personally hold. United Spirits also looks very good to me because it's showing a flag formation. Chances are once it crosses 1450, it might go up to something like 1550 on the upside. So you can look at that. And the other thing that I would like to say is that go for ITC. ITC will again test 500 levels. So at least a very short-term move can happen there as well. But the elephant in the room will be Reliance Industries. If it manages to stay above 29.50, then this rearguard action will definitely get more ammunition.
Rahul, just one quick word. I don't remember the note, but before we wrap up, you guys recently came up with a note wherein you either upgraded a sector or downgraded the sector completely. Excuse me for not remembering it, but it came 3-4 days ago. Was it on hospitality? Was it on something else? Can you tell us about the latest piece of research on a particular sector?
No, so I think Neeraj, they were both. There was one on the hotel sector where we have, put out a very detailed thematic, which I was just alluding to, and we've downgraded the entire defense sector to a sell. I think the valuations in the defense sector, we have looked at the last 3, 5, and 7-year averages, and I think most of these guys were trading between 1.5 to 3 standard deviation above long-term averages. For the growth prospects, we were not able to justify the valuations, but as I was talking to Tamanna just a few minutes back, I think for hospitality, we've been interacting with the managements of late as well. There seems to be business travel has sort of been the crux of it over the last couple of years, but I think there is a huge anticipation of foreign tourism revival, and there was a very detailed piece put out there where we have anywhere between I think 15 to 20% upsides on most of the stocks, Indian hotels, Chalet, Lemon Tree, EI. So there'll be a couple of them that are accumulates, but it's by and large a very positive view on the hotel sector with a recent downgrade to sell on the defense sector.
Just one quick question on real estate. We've seen some of those earnings come in and they've all been better than what we expected. Pre-sale numbers also look quite healthy. Now with this whole debate on indexation and what it's going to do for the sector is anybody's guess, but keeping in mind everything that we have, how do you approach the realty pack? Are you a buyer into this sector? And if yes, if you've got any preferences here, that should be helpful.
Samina, interestingly, the Prime Minister often quotes that 65% of India's population is under the age of 35. And K.K. Mistry used to always say when he was at HDFC that the average age of India buying its first house is somewhere between 35 to 40. So that's the extent of the demand that's there. But I think right from 2020 till now, the kind of home sales that have happened, I don't think that when you look at the absolute rate of growth, I don't think that's going to be, that much. I think the focus may shift a little bit towards commercial and retail as opposed to residential, because as you rightly pointed out, some of these have had very, very sharp runs. Financing has been very easy to get for a very large time. Mortgage rates were very favorable as well. So I don't know, and on top of that, I think if you look at barring the last quarter's results, I think if you look at last 5 or 6 trailing quarters results of Indian IT companies, at an aggregate level, there have been about 50 to 100,000 layoffs that have happened in aggregate. So that would affect the South market in a very material way. And the replacement of a real estate property is very, very large. Once you buy a house, I think it sticks with you for at least 15, 20 years before you, sort of go out and buy your next one. So I would not be as gung-ho on real estate today as I was, say, a few years back. Real estate ancillaries, where the replacement cycles are shorter, for sure, whether it's tiles, paints, etc. We could have that discussion separately. Or maybe even housing finance, but predominantly real estate, I would probably start looking more at commercial and retail than I would probably look at residential real estate.
Rajat, keen to know your take on the real estate space. Various reasons why it's up today. One of them could obviously be because they were worst hit yesterday. But are you seeing anything interesting here for a medium term or a short term trade?
Say that you can buy for a short term, take very short term, I would say things like Brokerage properties or DLF. But the point is that I quite agree with Rahul that at the moment real estate may not be in focus, and only there might be some scalping opportunities and things like that. If they go further up, you will see even the best of the lot, just as I said, Brokerage properties or DLF might also invite fresh selling. So they have extended their run quite a bit. And I really compliment Rahul on putting a sell on the whole of the defense sector.
Well, that's the view coming in from Rajat. Rajat, anything else that you've identified since market open in the last 15 minutes that could make a good trade either on the long or short side?
Well, you can buy, say, a stock like Ashok Leyland, which is now around 250. If it crosses 253, then it can go up to something like 266. And if you are planning for good investment bet, I would say there is one stock in the banking space that you can buy is IDFC First Bank. Vaidyanathan said that from the third quarter, things would really move up, and it has come to its major support area, which is just below 70. So your risk is much less, and it's a slow mover, but you will get good opportunities.
Rahul, just wanted to know if you have a view on autos. They were seeing a lot of seesawing over the last few sessions.
Yeah, we do. I think, there has been a reasonable pullback in terms of valuations. We've seen intraday pullbacks in Tata Motors, M&M, Maruti at various points over the last 1 month or so. So I think on the passenger vehicle side, we still continue to like Maruti. I think we're still looking at about a 13-14% compounded growth over the next 2 years. I think ever since Mahindra spoke about, their focus on return on capital employed, the stock's been a multi-bagger. But I think given the way we are looking at the monsoon spanning out, I think this would still continue to be a good year for tractors as well as for commercial vehicles. So I think Mahindra and Ashok Leyland respectively could be played there. And I think if you're playing two-wheelers, and I'm not including the EVs in this because there's been a lot of talk about EVs in the past, but I think Hero is not a bad bet. You're also getting it at about a 3% dividend yield or thereabouts. So I think in different sub-pockets of auto, I think these would be some of the ideas that we would recommend. And I think if you're playing it through auto ancillaries, we do like names like Sansera Engineering. We have a proxy to say a lead in like a Jamna Auto in the past. So we are not going in and aggressively buying. I think most of these stocks that I have told you would have anywhere between a 10 to 20% upside. But we are selectively definitely looking at ideas in the auto sector.
Okay. Rahul, Rajat, we'll leave it at that. Thanks so much for taking the time out and being with us. So really appreciate your time this morning.
Thank you, Neeraj.
By the way, must mark Nifty IT is the best performing index, 1.7% higher, and it's not one particular stock which might be taking it higher, it's across the board. If you look at the Nifty IT gainers and losers, no losers per se, but Tech Mahindra, HCL Tech, Wipro, Infi, all of them around 2% higher. So it's a broad-based move that's happening in Nifty IT. The other aspect to focus on is Airtel, and what is it that brokerages have made of those results, because the stock is up about 1% and knocking on the doors of 1500 yet again. Rucha Johnson with what the brokerage view is. Rucha, good morning.
Good morning, Neeraj. So before brokerages, I'll just give highlights of the results. Positive on India operations. Revenue was up about 2%. Net profit was up 7%, whereas wireless revenue was up about 2%. The other highlight is that ARPU was flat, around like 2 rupees up, around 211 versus 209 in the previous quarter. Now coming to brokerages, Citi is the most bullish one with around 19% of upside and a target price of 1750. Now it said that India CapEx shows sign of moderation according to the management commentary in the past quarter, and this is what drove the free cash flow higher along with deleveraging. Now this is when the brokerage house expects that shareholders could get dividend and buybacks from Airtel. Also talking about JP Morgan has a moderate upside of around 2%, but it was surprised positively on the India CapEx stability and acceleration in the free cash flow. Now revenue growth was strong in the homes segment, and Bharti Airtel also announced deferring of calling the partly paid up shares due to strong free cash flow and generated by lower capex and deleveraging. Now according to CLSA is also bullish on Bharti Airtel with upside of about 5%. The consolidated numbers were largely dragged because of African business, because of deleveraging, because of devaluation of the currency. Board also feels that there is no immediate funding requirement, is what CLSA has to say on the stock.
Okay, Rucha, thanks so much for that. 1% higher for Airtel as we speak. Keep an eye out for that stock too. What we do is take a quick break. Up next, some market conversations and some corporate conversations. Start off with Mr. Jayesh Gujral, MD of Pharma SGS.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the large street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys.
Good morning and welcome to Earnings Edge right here on NDTV Profit. We're now in conversation with Sirma on the back of the Q1 earnings, which saw strong revenue growth of roughly about 93%, but on profitability there was a slight impact and degrowth. To talk more about the Q1 numbers as well as a deep dive into the verticals that the company operates in, we're now joined by Mr. Gujral, the Managing Director of the company. Mr. Gujral, thank you so much for joining us today and a very good morning to you. Just to start off with, the Q1 numbers specifically, we've seen a very strong revenue growth across verticals like consumer, IT, as well as healthcare. But margins have been down in this particular quarter by about 440 basis points, coming at around the 5% range. Just if you could just talk us through, what has led to this margin fall. Is this an increased penetration of the consumer growth sector and just on these verticals as well, sir?
See, the business this quarter has been good. We have grown by 92% odd in the total revenue of the company. And as I had said in my earlier calls, that the business mix is seasonal. So in the first quarter, we saw a high proportionate growth of consumer business, which stood at about 54%. Now, this 54% consumer business led to a contraction in the material margin. We had a 4% saving in the operating overheads, and hence the EBITDA margin contracted by about 2%. So we're very confident that going forward, the annualized earnings which we had guided and the EBITDA margin, the plans remain intact. The high margin business would kick off in the coming quarters. First quarter was comparatively slow on exports also. Exports were only 16% of our revenue against a targeted figure of 20 plus. So going forward in the remaining 3 quarters, we believe and we are confident that the business would come back to normal with the revenue growth of what we had guided, and EBITDA of about 315 crores is in line of achievement.
Just want to get into the verticals that you operate in. You didn't mention about the consumer sector, but another strong growth engine is of course the IT as well as the railway space. I just wanted to talk us through these particular two verticals. Within these, what segments are you targeting for both IT as well as railway going forward?
See, IT growth is still nascent. We have the IT PLI, but we are in the process of tying up with some customers. There's nothing concrete as of date. So I would not be able to put a figure on the IT business. On the railways business, we have orders. And as I had guided earlier, this year we should expect railways to be anything between 60 to 70 crores of revenue in this year. The verticals which we operate upon are automotive, industrial, healthcare, railways, and consumer. So all the verticals are seeing a growth, and we have tied up with some good brands in the industrial sector, which would see turnovers coming in the second to third quarter of this financial year.
Just if I could, come back on the IT part. You said that you are still tying up with customers and looking to, increase that particular business. But you already are applicable. So this is the IT hardware PLI, if I'm not wrong. And what kind of PLI benefit did you have in the last year, and are you expecting the same in this particular year as well?
See, IT PLI, we got the application approved in November of last year, November of 23. So there was no IT PLI benefit factored in the books because we got the approval pretty late. In the current year, we are tying up with vendors where we can leverage the application of IT PLI which we have got. But currently there is nothing concrete on the table, and hence I really can't put a figure to it that what will be the IT revenue because of the PLI application. We do our IT revenue of about 70-80 crores. That will continue in the normal course of the business. But how much leverage we can get out of the IT PLI application, I really can't say a figure today till I tie up with a customer.
Understood, sir. And anything on railways? Are you also currently doing orders for the Kavach? Because we are expecting some orders and a big push over the next couple of years. We've seen some commentary in the budget as well. Are you already tied up with some customers for this, or are having conversations? And if not Kavach, what other verticals do you operate within railways?
See, in railways, we have tied up with a Japanese ODM supplier, which is doing the Kavach and the other safety signaling equipments. So we are a tier 2. We have an ODM Japanese partner for which we will be making and then supplying it to the railways.
Now, just wanted to talk about the healthcare division as well. We've seen an increased focus for the company in this particular vertical, and you made an acquisition also of a company called JDHL last year, and you did inform that you have a research design center coming up in Pune as well. If you could just talk us through what has been the focus and what could we expect from this vertical. You are also focusing on a lot in ODM in the medical space as well. But within the EMS segment, we've seen medical equipment being very subdued for most players. So how, for Sirma specifically, if you could talk us through this vertical and what kind of expectations do you have for this year?
See, for the healthcare business, including medtech devices, our plans are intact, and we expect to do a significant revenue of about 350 plus crores, which would be both EMS and the products. The design center which we have set up in Pune will be commissioned later part of this month. And we already have got some good leads into the ODM designing contracts. I'm not at liberty to name the customer, but we have got a good $2 million contract on designing for a medical device. The revenues of which, this is a designing income which I am referring to, but the product income would flow it in the coming years, 25, 26, 26, 27. On a whole, the medtech business looks to be on a sound footing, And as I just guided that we should be ending up the year with about 350 crores of healthcare business.
Well, Mr. Gujral, thank you so much for joining us today right here at NDTV Profit and speaking to us in a very detailed conversation for Q1. We wish you the best and commiserations for being reappointed for the next 5 years. So look forward to our next conversation as well. But thank you so much for joining us today.
Thank you very much. Thank you.
Well, that's all the time we have on this edition of Earnings Edge. Stay tuned to NDTV Profit for more.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Motherson Sumi Wiring India Limited has reported a stellar set of numbers in the first quarter of the fiscal, with the bottom line jumping by about 21% and the revenue is up by about 16.7%. To talk to us more about the numbers are the company's CFO Mahinder Chabra and CEO Anurag Gehlot. Gentlemen, welcome to NDTV Profit.
Thank you very much.
My first question is to you, Mr. Gehlot. In the press statement accompanying the earnings, you mentioned about some automotive mega trends that are working in your favor. Can you tell us what are those mega trends, so to speak, and how are they impacting your earnings?
Okay. If you see that the market has, passenger vehicle particularly market has grown by 6% and our revenue has grown by around 17%. And this growth is majorly because of two reasons. One is obviously the volumes are growing up, that's fine. And the other one is that the customers are choosing now the feature-rich model vehicle. So the upgrade is happening. So once the upgrade happens, then the content of wiring harness goes high. And as you choose the top model, content goes high. So our sales directly get impacted because of that. So if you see that SUV is still growing into the market, and that is one of the main reasons that how MSWIL is getting benefited out of.
Okay, so aren't you seeing any impact of the inventory buildup that is actually being seen in the industry in the last 3 months or so?
We have to see it the past of how the vehicles are selling or how the market remains. I think traditionally Q1 remains a little weaker side if you see in the past. And then, as you know, that all the customers are heavily investing into the capacities. So it's just a matter of time, or we can say, some weeks here or there. And I think market looks positive to us.
To add to that answer, there's also a case of price rationalization that we are seeing from OEMs. They're launching new models with certain features. They're reducing the prices of a top-end model. How does that impact you? They say that it's reducing the impact on the supply chain. What is your take on that, sir?
This is better. This question is better to ask to the OEMs only, but I can only say that we are very much aligned with to the customer volumes that they are gearing up. And there is no as such impact on us directly because of giving their offering to the market.
Mr. Chhabra, coming to you, we see that your EBITDA is up about 15%, but there's a marginal decline in the margins. That's about 18 basis points decline year on year. Mr. Chhabra, can you talk to us more about it? What's the dynamics there?
Yeah, so if you look at profitability for the quarter, so first of all, we measure our performance in terms of profitability on ROAS, return on capital employed, and there we have a guidance of 40%. And we are well on track to deliver beyond 40% for this quarter as well. However, if you look at the P&L, we also have two plants which are coming up. So there are certain ramp-up costs which have been there in this quarter in the P&L. So to that extent, the EBITDA is getting impacted because of that. But yes, as a profitability, we look at ROAS as our measurement, and we are well on track to deliver more than 40%.
So the margin impact is mainly due to the new plant that has gone on stream in July?
That's right, yes.
All right. You also intend to increase the utilization at this particular plant. Can we expect much more impact on the margin going ahead in the rest of the fiscal? Mr. Chhabra.
Yeah, okay. So as far as margins are concerned, yes, the new plant that has been put up, the one plant will start operations in July. It's already started the operations. And we will be getting the customer orders as per their forecast. So we should also have the revenue getting generated from one of the plants.
Okay. Coming back to you, Mr. Gehlot, most car makers are in expansion mode. They want to increase the capacity substantially between now and the end of the decade in 2030. Electrification is coming in, premiumization is coming in. So where do you target where do you fit in, and what are your targets accordingly?
If customers are increasing their capacities, we are very much aligned to that. And that's the reason you have seen these two new plants which are coming up. And there are furthermore plants which will be coming up. So we are very much aligned to these customer requirements. Obviously, this is a spread of next 6 to 7 years when these what targets or what volumes they are predicting that they are to achieve. And we are also budgeting ourselves, and we are aligning them ourselves according to these increasing capacities in the different location. So as on today, we are 28 plants, and they are very near to the customer vicinity. Obviously, that gives a lot of confidence to the customer also. And communication remains very good. So our all plans are wherever the customers are going, we are just following them.
All right, because you actually preempted my next question is that are there any plans for new plants, so to speak, near where the centers are coming in? So any more new plants?
Yeah, definitely. You will hear from us maybe later in the year.
Okay.
Because we are, as I said, we are aligning with the customer requirements, and we just follow the customer. So if customer is going in any part of the country, we just try to be very near to them.
Okay. Coming back to you, Mr. Chhabra, you say the EV revenue grew by about 50% year on year in the first quarter FY25. What is the percentage of the EV business in the overall revenue at this point of time, Mr. Chhabra?
Yeah, so if you look at the current quarter, the EV contribution will be close to 4% of the overall revenues.
Okay. So will it keep on increasing here on? Because we have seen certain slowdown in terms of adoption, so to speak. The numbers are not increasing substantially. So is there a target that you have set that how much revenue should come from the EV business, Mr. Chhabra?
So I would say it would be in line with the demand of EVs in the market. I mean, depending on the demand, we would be supplying the wiring harness to EV manufacturers. So it largely depends on the demand in the market for EVs.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
When the whole day
Good morning and welcome to NDTV Profit. This is Talking Point. I'm Muralidhar Swaminathan. My colleague Neeraj Shah will join in a while. He's had a long morning and he's taking a short break. He'll come back. But the other Mr. Shah, Nilesh Shah, MD of Kotak Mahindra AMC. He's an expert on markets, manages one of the largest mutual funds. We don't need any special introduction. He's also busy and we can see him. He's stuck in a car in a traffic. Nilesh, good morning and welcome to NDTV Profit.
Thank you, Murali. My pleasure being here.
Okay, so I will start with the first question. What is the root cause of the current sell-off? Before we go on to other questions, what is your assessment? What do you think has triggered this big sell-off?
Murali, the simple answer is that sellers are more aggressive than buyers. Why have suddenly sellers become aggressive? One, partly it could be profit booking. Our markets have delivered tons of return to investors. And in a risk-off market, people don't mind booking some profit. Second, there are concerns emerging globally. Some people say it is yen carry trade reversal. Some people say it is geopolitical risk in Bangladesh, Israel, Iran, and so on and so forth. My feeling is that it's a combination of everything, which is pushing sellers to sell aggressively and buyers to bid conservatively. That mismatch is resulting into market correction.
Right. So how much weight will you put to this fear of US recession? Because, that was used, the jobs data was used by players in the US market on Friday to say that, look, recession fears are back, and that's being seen as one of the reasons. How much weight will you put to US recessions?
So one, the whole market has been going wrong about US economy, including US Fed. From inflation is transitory, it will remain elevated for a longer time, to now looking to cut rates to support economy, has shown how difficult it is to predict US economy, even by the mighty Fed. Our knowledge on US economy is limited, and our linkage to US economy is also limited, bearing sectors like technology which get influenced significantly by US economy. Our domestic focused sectors have very limited linkage with US recession. So my feeling is that our markets have run up a lot. People don't mind doing some profit booking, and the cause could be US recession today, Fed cut tomorrow, yen carry reversal day after tomorrow, and geopolitical risk some other day.
So it could be any reason to book profit in an overvalued market. You really brought to light in your tweet last week about how a segment of the market is so overvalued that we are discounting some 50 years of earnings. Can you throw some more light on it? And meanwhile, I'll also welcome my colleague Neeraj. Neeraj is also joining me in this conversation. Go ahead, Nilesh.
So essentially, it was back of envelope calculation to show how market is far more forward looking. There are about 359 stocks which have delivered more than 100% return since COVID low in BSE 500. There are more than 28 stocks today compared to 93 stocks in 2020 pre-COVID, which are trading at more than 50 years. That means they are discounting the earnings of company as much as in 2074. Third, we looked at returns from COVID days. The return for broad market was coming at 22%, whereas the 20-year return came at 14%. It meant that from 2004 to 2020, the returns were subdued. And then 2020 onwards, the return took off, which means that at today's valuation, one will have to moderate return expectation. So this was more of a back of the envelope calculation on BSE 500 to suggest how markets are far more forward looking and extremely optimistic about future. Undoubtedly, if earnings growth continue their momentum, then these numbers will change. So limited point here, markets are optimistic. They are discounting future very, very positively.
Neeraj, would you like to step in?
Nilesh bhai, one question therefore. Does this make markets vulnerable to a large drawdown? Or do we all need to rethink how we're looking at markets simply because the nature and the power of the local investor in the last 4 or 5 years is very different from what it has probably ever been?
So Neeraj bhai, there are many people who say this is all due to domestic money. Undoubtedly, it is domestic money, but no one comes here to lose money. They all come here to make money. And in the markets, we have all kinds of people. some experienced, some not so experienced. My feeling is that overall people are positive on Indian economy. There is visible growth, there is good governance, and there is good corporate profitability. While despite market run-up and trading at all-time high level, our valuations are not at all-time high level, albeit it is trading at premium to other peers. So my feeling is that it's a combination of not just liquidity, it is also confidence about the future growth. And to all those people who are bearish on Indian market and believes this is a bubble, I have always asked one simple question. Are you willing to short Nifty at this level for next 10 years? So far, I haven't met anyone who is interested in taking my proposal.
Okay, but 10 years may be a long time. I'm just trying to understand, because your post then would have made one think that is Nilesh Shah cautioning about the valuations, and could Mr. Nilesh Shah be bearish for a shorter term? I know you don't take tactical calls and you're a mutual fund guy, so you won't do this. But if you are not, would you believe there is a probability or a higher probability of a correction in the Indian markets currently? We've seen 4%. Can there be more?
So, Neeraj, it is always difficult to predict the market in the short term. In March 20, how many people would have predicted that Nifty will be trading at 25,000 or 24,000 in 2024? Hindsight, it is always easy to say, oh, this is yen carry trade reversal, this is geopolitics, this is US recession. But trust me, more people have lost money waiting for correction than actually in the correction. All we are saying is that one, market is optimistic about future for right reasons. Second, valuations in many cases are reasonably well ahead. And third, please moderate return expectation and invest with a longer term horizon.
Okay, so we will not go back to predicting where the indices would be, but this question will be about factors going forward. What are the factors that will move the markets? Now, this is fundamental, because at one end of the globe, you have US, which wants rate cuts, and that could be coming in a few months. And at the other end, you have Japan, which is hiking rates. It might put a little pause to hiking rates, but it is on that path. So you have a divergent global interest rate scenario that is emerging. How will markets react to this? Will there be a lot of shuffling around among different asset classes, like moving from equity to bonds, bonds to oil, and back and forth?
So, Murli, undoubtedly asset allocators will try to sell what is expensive and buy what is cheaper. There will be undoubtedly those movement. Side mein khada. Now, if we look at India position, my feeling is that investors will look to buy into correction. Let's look at from a foreigner's point of view. The foreigners are today either equal weight India or marginal underweight India. There is a reasonably good chance that India's weightage in MSCI emerging market index will go up. This will make many foreigners underinvested in India. Can they afford to remain underinvested in a growth market like India? Answer is undoubtedly no. So they will be using correction as an opportunity to invest. In every single IPO coming out of India, OFS coming out of India, we are seeing foreigners looking to buy and compete with mutual funds aggressively. Now let's look at domestic investors, insurance, mutual funds, pension funds. We all will be a buyer of India growth story. Let's look at retail and HNI. People who are expressing bearishness in the market are ultimately looking to buy at correction. So overall, my feeling is that corrections will be bought into. This time, investors have also become matured. This is real life Lagan movie being playing out. As you know, in Lagan movie, local team defeated foreigners. In COVID time, we saw one day international being played out where foreigners were selling for March, April, May, June, July 2020. They sold close to 70 to 80,000 crore cash equity. Retailers via mutual fund kept on buying. Then foreigners realized that Lagan mein jeetna mushkil hai. So they started playing test match. From October 21 to June 22, they sold 250,000 crore worth of equity. Retailers kept on buying slowly and steadily. Finally, foreigners realized that retailers are going to win test match also. So they gave up on test match format, came into T20 format. On the election result, they played like T20, sold about 21,000 crore in cash and about 8,000 crore in futures. Retailers bought that into. So my feeling is that there is a real life Lagan being played between domestic investors and global investors, and everyone will be looking to buy into correction. Now, someone may buy a 10% correction, someone may buy a 20% correction, but every correction will be bought into by local and global investors.
In fact, yesterday you and your other colleagues in the industry must have bought what FI sold because FI sold 10,000 crores worth of shares and the domestic funds bought about the equal amount, 9,500 and odd crores.
Undoubtedly, mutual funds have asset allocation and balance advantage product, which can buy whenever market dips. The SIP flows have been very strong. And there is also new money coming in from retail and HNI investors whenever there is a correction. So there is a reasonable amount of depth in Indian market. Our fundamentals are good. Our governance standards are good. And we, provide one of the best opportunities on a price to earnings growth basis in emerging market. Now, gold doesn't come cheap. You have to pay the price of gold to buy gold, and which is where Indian markets are trading at premium valuation to others. But that doesn't mean that our markets cannot go down. Of course, they'll go up and down like any other market.
Okay. Nilesh bhai, the other question is a tale of two halves, if you will, or a barbell approach that Indian markets currently have, wherein people, there is enough opinion out there on what some of the, on the frenzy on some of the stocks, for example, in the defense space, in railways, in the EMS sector, etc., all of which probably form a part of those stocks which are above that 50, 70, 100 multiple, right? And the other end is the safety in valuations, but not the kind of growth that that the expensive names are showing. I would love to understand the current stage. Would you believe that there is merit in choosing safety in valuations over the kind of growth numbers that some of the expensive names are showing?
So Neeraj bhai, you hit the nail. Value is what you get and price is what you pay. This is the market where you focus on quality over momentum. This is the market where you focus on reasonable valuation over expensive valuation. This is the market where you focus on diversified ownership and market discovered prices, then low floating stock, concentrated holding, and market manipulated prices rather than market discovered prices. Now, in many stocks, holdings are concentrated in few hands because there is very, very low floating stock. This is resulting into valuations which are way ahead of their fundamentals and puts tremendous pressure on companies to deliver growth which is well beyond their capacity, in our opinion. Now, will these stocks correct today or tomorrow? I don't know. Will they correct when supply emerges, when minimum public shareholding norms are enforced, when some of the promoters of these companies realize that my shares have really run up and let me book some profit? Be the case as it may be, whenever supply emerges, the stocks are likely to fall quite sharply. And hence, focus on quality over momentum, high floating stock market discovered prices versus low floating stock and concentrated holding, and focus on reasonable valuation over expensive valuation. Do remember, price is what you pay and value is what you get.
Right. Now, if we have to focus on quality and liquidity and the stability part of what you're saying, what is the size of that basket of stocks? Is it 100, is it 200, or is it 300? Because anything beyond 200 or 300 looks quite vulnerable from all the factors and criteria that you have mentioned, Nilesh.
So today, if we look at large caps, maybe 70-80% of large caps falls in that bucket. If we look at small and mid cap, in mid cap, maybe the ratio is 50-50. Small cap ratio reverses to maybe 30-70. So there is opportunity in all basket, small, mid, and large. There are some stocks across private banks, technology, chemical, and consumer discretionary, where valuations are still reasonable, below or around their historical averages. Growth looks fine, and hence one can look to invest from a valuation point of view. It does not necessarily mean that they will start outperforming market from tomorrow onwards. Unless until supply emerges, it is unlikely that low floating stock counters will correct. Their prices can rise even further, but eventually they will correct, and hence for an investor, it is a trade where you keep on reducing your holding in low floating stock, expensive valuation stocks, and try to buy high floating stock and reasonably valued counters.
Yeah. So what about FMCG sector? Is that does that fall in this category? Because they are always assured of growth. They grow with the economy. They grow with the changing trends. They grow with monsoon, and they are not huge capex heavy companies. And what do you think FMCG would be? Because they move very slowly in the markets,
So again, FMCG companies cannot take their business for granted. They have to keep on investing in the brand. Their brand should remain relevant for the new sets of consumers which are coming in. And most importantly, they have to invest in distribution. Murli, just to give you a small example, under Pradhan Mantri Gram Sadak Yojana, rural connectivity has gone up substantially. There were, let's say, old FMCG companies which were serving mainly urban India and semi-urban India, but not rural India because of lack of connectivity. When this Gram Sadak Yojana started building connectivity, they probably didn't move with the time. And that allowed emergence of many FMCG companies which are leveraging rural road connectivity to capture rural market. Now, this requires different skill sets of distribution. But people who are early mover in capturing rural market, they are witnessing growth. So we have seen product categories where in couple of states, this kind of companies are able to sell what established companies sell all over India because of their connectivity, because of their penetration. So my limited point is that yes, FMCG looks good. Election has put money in the pockets of consumers. Budget is spending on skills and apprenticeship allowances, and there is also likelihood of good monsoon. All these things will put money in the pockets of rural consumers, and that should work well for consumer discretionary companies.
Nilesh bhai, I have one final question. You're sitting in the car for us, so I'll make this quick. What to your mind is the probability of a further drawdown? Is it purely Indian valuations, or will it need to be something global in nature? It could be a yen carry trade, it could well be a geopolitical piece, or Fed rate cuts not happening, or what have you. What is, or something else that you may have thought of? What could be the biggest known factor? I know usually it's an unknown, but what amongst the known factors could be the big factor?
So Neeraj bhai, how many people were talking about yen carry trade reversal 10 days back? It was unknown, and it came and hit, and today everyone is giving yarn on yen carry trade reversal. All I am saying is that let's bow to the might of the market. It is well beyond any individual, and We have to just focus on how do we react to the correction. Every correction provides an opportunity to participate in long-term India growth story. Choice is yours. Do you want to be a trader going up and down with daily swings? Or do you want to be an investor using every correction as an opportunity to buy?
Okay, Nilesh bhai, we will leave it at that. Thank you so much for taking the time out and being with us. Really, really appreciate your time this morning. All right, and of course, Nilesh bhai, okay, we lost him, but should have wished him a belated happy birthday as well.
Oh, yes, absolutely.
We missed out on that.
Yeah.
Okay,
And
but
also, yeah, I think Neeraj...
do we still have him? No, we still have him.
I think
we lost him. Okay, Nilesh bhai, just before we let you go, wishing you a belated happy birthday and many more to come. Okay, I think he's gone. Never mind.
Okay, so what we are gathering from the morning in the conversations that you have had with many guests and with Nilesh is that there is a certain comfort level that is coming to the markets. The comfort are 2-3 points that are emerging. One, whatever we are seeing in the US and in Japan and in the rest of the world are what in market parlance would be called market internals. You know, you book profit, you come out, use something as a trigger. Now, from here onwards, I'm not saying that the markets will be stable. It will be volatile, but yesterday's picture gave the impression that it would be a contagion. But today's picture is giving a slightly different perspective to the market. And after what Nilesh is saying, that look, at every fall, people will buy and we will support, which was demonstrated yesterday.
Yeah, well, and maybe that is a defining factor of this bull run versus some of the others. But interestingly, we also spoke to actually just before we get to that, one other key thing that emerged in some other conversations, including I think what Nilesh had to say as well, was that because it's so difficult to predict what will happen tomorrow or in the future, the best strategy might be to look at your portfolio and try and ensure that that is ring-fenced against valuation risks and against business loss risks. And as long as that is done, sure, you may underperform if the markets were to correct, but over the slightly medium term, that will hold you in good stead. I think that was the other key takeaway for me.
No, absolutely. In fact, that comes out in most of the conversations we have as far as investors are concerned. Yeah. We are not talking about traders. Today, traders will come, they'll say there is a 1% rally, they will sell on that rally and they will try to cut their losses. But as far as investors are concerned, very clearly, these things will not affect your long-term holding. When I say long-term, not 20 years, or not, some people hold for 20 years, but this is very clearly, you should have solid stocks in the portfolio. And this is an opportunity to revisit the portfolio, weed out the weaker ones, and strengthen your portfolio. And maybe you would have booked some cash in the process and keep some cash on the sidelines.
Yeah, yep. I think that's the key summation. But so as we wrap up this edition of Talking Point, a differentiated version, here out as we wrap this up, Dr. Edward Yardeni of Yardeni Research, who spoke about the yen trade and how would this impact other Asian peers. He also spoke at length to us about his views on India.
Well, it's difficult, but that doesn't mean that I can't go and agree with your answer in the affirmative to your question. I think we may really have seen of the carry trade unwind happen pretty quickly. And I think to the extent that key Japanese officials are basically saying either implicitly or explicitly that maybe they're going to be careful about any further tightening, that in turn would lead to some stabilization in the yen. It certainly has seen some improvement in stock prices in Japan. And so this earthquake that we saw in Japan, it clearly spread very quickly to the rest of the world, but I think it may be calming down already. Part of the reasons for the sell-off on Friday was the weaker than expected employment report for July. However, we had a really close look at it and concluded that it might have been the weather. I know that the Bureau of Labor Statistics said that Hurricane Beryl, which hit Texas in early July, didn't have an impact, but still there was plenty of evidence that the weather was bad enough around the country that it might actually have depressed the data. And today's, as you mentioned, today's data on the non-manufacturing purchasing managers look pretty good. So all in all, I think the economy is still pretty resilient. I think we'll get over this latest recession scare. You know, we've had this recession fear for the past 2 years. It's the no-show recession. It's the most widely anticipated recession that hasn't appeared. And there's still concerns that it might at some point, but I don't think it will.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying.
Welcome, this is Samina Nalwala, and over the next half an hour we'll take you through all the action in the FNO markets. It's the calm after the storm yesterday. D Street is recovering after the big sell-off in trade yesterday. A dead cat bounce is what we have. The Nifty and the Sensex both trading with gains of about 0.7%. So we're off the day's high point as expected. Got a pretty healthy gap up in trade this morning, but have sold off just a little bit in the last 1 hour or so. Broader markets are performing in line with the benchmark index. The VIX has also cooled off nearly 11%. The sector that's leading the recovery today has got to be IT, up about 1.8%. Along with that, you've got other sectors like metals as well that are staging a little bit of a recovery. And real estate, which I forget to mention, is up 2.5%. So all in all, it looks like like par for the course. Agam, after yesterday's big fall, a little bit of sanity returning back to the street. Whether it's here to stay is anybody's guess. But for now, we shouldn't be complaining.
But I don't want to speak too soon because we've actually seen the markets come off by quite a bit.
And they've already come off since the time from early trade this morning.
Look, whenever you have such a sharp move, such a sharp decline on an intraday basis, specifically when it comes to the benchmarks, you have to remember that, there could always be a little bit of remaining selling left. And it's not to suggest that yesterday's move was quite substantial in the way things could have panned out, but there are also some technical parameters which actually play out in the markets, and to a certain extent, a lot of players who would be long the markets would potentially be trapped. Probably will use this today's day of trade to move out, considering the prices are just a tad bit favorable. And after that, of course, from there on, we continue to see determining of the markets in terms of price action. But for now, of course, markets are off days highs. In fact, the Fin Nifty and the Bank Nifty are in fact at days lows, even though they are in the green, and Fin Nifty has gone into the red, by the way. There certainly are some things that you'll need to bear in mind before we move in. Before we talk about the futures and options space, I think it would be pertinent to address Gokuldas Exports and the kind of challenges that they are at the moment facing is in Bangladesh. Samina, do you want to take this over?
Yeah, so I think the management has indicated that if there is instability in Bangladesh, one thing that could work for Indian textile companies is that these international brands such as your H&M, your Gap, the larger retailers worldwide who import from countries like Bangladesh may even consider shifting focus and buying out of India as opposed to Bangladesh. But we've got with us the management, Mr. Ganpati, who's MD of Gokuldas Exports now, joining us to talk to us about what the Bangladesh impact could mean for his company and the sector. Hi, Mr. Ganpati, thanks a ton for joining in. First up, you want to start by telling us if you've got a presence in Bangladesh. Is there any sort of trade relationship you have in Bangladesh?
Good morning. No, certainly we do not have. We do not have any business that we do out of Bangladesh. So at the moment, all our manufacturing capacities are in India, and then we have manufacturing capacities in Kenya and Ethiopia. So currently, we don't do anything out of there.
In terms of clients that you sell to, do these clients significantly buy from Bangladesh?
Of course. Okay. So Bangladesh is a very large garment manufacturing, country, and almost all of the large retailers buy a lot from Bangladesh.
So would it be fair for us to assume, Mr. Ganpati, with political instability now in Bangladesh for the foreseeable future, some of these big buyers of yours like the H&Ms and Gaps and Zaras of the world may start increasing their purchases from India to offset what they were doing in Bangladesh, just to ensure that, of course, there's no disruption in supply in that sense?
So many brands were looking at diversification, but I think the speed at which events unfolded in Bangladesh accelerates some of the thought process of, diversifying away from overexposure to that country. So many of the brands who buy a lot from that region may, consider going forward to, diversify away, and India naturally becomes a safe port of call for many retailers to source from, given our vast supply chain base. So we have a good mill base, especially in the cotton viscose area, and a strong garmenting base as well. So there will be a lot more retailers who will consider incremental sourcing from India. But all of this will evolve over a period of time. Everybody is waiting and watching as to how soon the events settle down in Bangladesh. If those factories come back online quickly, then even then there may be some movement, but it all depends on how things unfold in the next week, 10 days there.
So Ganpati, just wanted to understand what sort of a cost differential is there when it comes to sourcing products from Bangladesh as compared to sourcing the same products when it comes to manufacturing in India. Is it substantial?
There is some degree of difference between India and Bangladesh. Primarily, it is induced by the cost of labor in Bangladesh as well as a weak currency that Bangladesh has. So again, Bangladesh also has humongous capacities that they have created over a period of time.
Right.
So many brands prefer Bangladesh for a slightly lower cost, which may be of the region of 10%, 15%, whatever. Plus, European retailers prefer Bangladesh because Bangladesh goes duty-free into Europe. So that is a 12% advantage straight off the bat. So that's something which, we can't even combat. So that's the advantage which Bangladesh has, particularly going towards Europe. If as and when India has an FTA, maybe that will become a level playing field with UK and Europe. But at the moment, Bangladesh enjoys that advantage.
Right. One last question, Mr. Ganpati. So while this may be a sentimental positive in some sense for the sector, and you've seen companies like yourself trading with 11% gain on the index right now, but is there any tweaking to orders from your clients since the Bangladesh crisis came to light about 10, 12 days ago, or there's been no actual quantitative changes just yet?
It's a bit early in that sense, right? Because we normally do bookings well in advance. So, we book about 2 quarters in advance. So at the moment, nobody can directly shift things because supply chains are well entrenched and tied in. Having said that, brands are always looking for alternate options and will be, having soft discussions on, in the event there is disruption, what do we do? Kind of conversations, but these are all early days.
A final question from my end as well then. So what are the key brands that Gokuldas Exports deals with, which also have a relative presence in Bangladesh as well?
So we deal with all the top brands in the world, and all the brands that we deal with also source from Bangladesh.
Right. Okay, Mr. Ganpati, we'll leave it at that. Thank you so much for joining us and, taking us through, the current situation and kind of potential advantages the current situation in Bangladesh may pose as far as some of the Indian outfits are concerned. Of course, given the current environment, we're going to have to continue to keep an eye on how things develop. But before now, this is how things stand. Of course, Gokuldas Exports, the price of that particular stock is up as much as 10.5% at the moment. We'll continue to give you updates there, but we shift focus to the futures and options space. And we get in Sneha Seth of Angel One and Kush Bora of kushbora.com, who's joining us on the show. Good morning to both of you. Thanks so much for joining in. Sneha, I start with you on your take on the benchmarks. The Nifty is holding strong, but that is not the case for the Bank Nifty, the Fin Nifty. How are you assessing both these key indices and how would you trade them?
Yeah, very good morning. If you look at the market and yesterday's selling, I think though Nifty is trading positive, but I think on the higher side, the gap zone around 24,300, 350, 700, that zone should be acting as a hurdle. So today again we saw Nifty heading towards 24,400, and from there we have seen some profit taking. So I believe at this point in time, looking at the India VIX even, which is around 18.5 today, so it is looking that market, any bounce back should be, used to exit your longs. And in case of any further declines, I would say that, should avoid any kind of a bottom fishing, especially looking at the India VIX. In banking index also, if you see the same thing, the gap zone should be acting as a resistance, which is placed around 51,000, 51,100 on the higher side and 50,800 on the lower side. So that is the gap zone for the banking index as well. Any correction below yesterday's low can bring in both the indices on the lower side. In case of Nifty, we can expect a correction at least towards 23,400, 500 odd zone. In case of any correction below 23,900, which is yesterday's low. And in case of banking index, any correction, because banking index is currently trading around the 89 EMA. So maybe possible that, any correction at least below the yesterday's low, that is around 49,700 zone. we can see a further fall at least towards 48,700, 800 odd zone. So overall IVs are not very in a not a very comfort zone. So any pullback should be used to exit their longs.
Right, Kush, what is your call on the index? I mean, we started off okay. There was a little bit of a nice dead cat bounce this morning, but very clearly that's getting sold into as we see it. The Nifty is well off the day's high point. Fin Nifty is in negative territory. Do you feel this is once again opening up an opportunity for traders to go short on the index?
Hi, Samina. First of all, very good morning. Well, you're right. This, what we saw is now what we can call it very clearly as a dead cat bounce, at least for the bank Nifty that slipped into red trading, at the low point of the day. I think Nifty is one index that, you could avoid for now. The reason being that, we've, before yesterday's fall, we've seen a lot of sector rotation that has come in. And, that's been the saving grace for Nifty. You've got one or the other sector like an IT, an auto, perhaps sometimes, oil and gas, on some other days. That have sort of held, Nifty in range. So I think you could perhaps avoid Nifty for now for either a long or a short trade. But I think a clear trend is on the bank Nifty, which is downwards. There are indications that bank Nifty might reverse, perhaps even be the leader of the next rally. That the markets see. But just for now, I think the pressure is unrelenting. I agree with Sneha that yesterday's lows, both on the Nifty and the bank Nifty, are the key levels to watch for. Once those are broken, I think we can see further downside. But if I were to take a short position, I would now take it on the bank Nifty with 49,700 being the first target. Once that is taken out, you're looking at a 49,400 kind of a level also on the downside. And the stop loss here could be 50,300, 50,400 range. So go short on bank Nifty. That's a weaker candidate even now.
Right, go short on Bank Nifty. Sneha, two other spaces that are doing too badly this morning and are probably leading the recovery is IT and metals. I think anything that was part of the global turmoil yesterday is doing okay this morning. Are you spotting any encouraging long trades here in either of those two packs?
If you look at the overall chart structure for overall IT stocks also, I think though we may see some consolidation here, but expecting an up move and buying, I would refrain from that. At present, I would stay away from longs for the time being, and would focus on the stocks which is bouncing back, and we can go ahead and short those candidates. So that would be the focus for now. I would avoid any longs at this point in time.
All right, I think we can talk about stocks then. Well, at the moment, we should probably start off with those stocks which are actually seeing an increase in open interest and see how things are faring there to see whether or not there is any short covering. So that means that the second plate will be a little bit more interesting. But we start off with those stocks which are actually seeing an increase in open interest. So if we can have that for you on your screen, and we can in fact get that and potentially see how things are faring as far as the stocks are concerned. So yes, you have Deepak Nitrite and Cummins India. Even though they're advancing in the underlying about 1.5%, we don't have too much in terms of your open interest change. On the other hand, Marico is looking at a decline around 4%. We are looking at a marginal weakness in Shree Cement, Bata India, maybe some shorts coming in. In terms of stocks which are actually seeing unwinding in open interest, we should potentially have that screen for you. So interestingly, all these names are looking at short covering, though not unexpected, because today is still a day where we've seen plenty of advances and a lot more in terms of advances as compared to declines coming through. So something like a UBL, a Dixon Technologies, a Naveen Fluorine, Maruti Suzuki, all of them advancing, but with very, very, very little short covering coming through. With that, let's take a look at stocks that are on our experts' radars. So, Kush, stocks that are looking interesting to you this morning.
So, again, despite the kind of the cautiously optimistic outlook, that we have, I think, one sector that is doing well, hands down, is the chemical space. One of the stocks, that I have on my radar, you've already made a mention, which is Deepak Nitrite. Open interest action through the price action itself is actually quite encouraging in the sense that, there is relative strength, in this space. So 3080 is the first target, 3130 is the second target, 2950 is where you place your stop loss. The second stock also happens to be from a similar space, which is UPL. Now, we had seen the impact of results on this counter. It actually fell quite a bit. But yesterday, too, when the markets were under such tremendous pressure, this stock was trading in the green for the most part of the day, then eventually gave off, but it was still holding up. Today, we're seeing a fair bit of recovery in this one. So 555 is the first target, 570 the second target, 530 thereabouts is where you can place the stop loss. So risk reward ratio is quite favorable. In fact, if you want to take a positional trade, you could do so with a slightly deeper stop loss as well, close to 515 levels. So all in all, I think this space will continue to do well. This is one that has seen quite a bit of relative outperformance. If you want to go long, UPL and Deepak Nitrite are the two stocks that we have on our radar.
And you've liked Deepak Nitrite quite a bit, Kush, in the last couple of weeks. So it's been something that you've recommended consistently. And this morning, of course, the counter looks good. Their earnings have also beaten street expectations. Sneha, what about you? Technically, on the charts, any trading ideas for our viewers?
So I have a two sell call. The first one would be ICICI Bank. If you look at the overall chart structure, recently in the correction, we have seen some short formation. I believe we can go ahead and short this counter with a strict stop loss of 1180 on the higher side. 1180, 1190 zone should be acting as a resistance. So that should be the stop loss. And on the lower side, 1150 would be the first target. Any correction below that, it can bring it towards 1130 odd zone. Apart from this, M&M from the auto space looks good for the selling. I think last three sessions we have seen decent short addition. Now the counter is trading near the previous swing lows, which is placed around 2680-85 odd zone. So it is trading below around those zone only. But I believe looking at the overall selling pressure and the shorts addition in the future segment, we can see this counter going down towards 2547, and the upside resistance zone, which is around 2800 on the immediate basis, should be acting as a resistance. So that can be maintained as a strict stop loss.
Sneha, Kush, thank you very much for joining us this morning. A quick check on the index. The market is trading flat with a slight positive bias, well off the day's high point, pretty much at the day's low as we see it, 127 points. But let's not forget, we were trading closer to levels of 24,350 at the day's high early this morning. The breadth's also deteriorated a little bit. You've had a new listing, AKM Drugs, that's had a good response from the street, up 12% as we see it. We'll take a break. We'll come back. We'll be talking to Capri Global on the other side, get a sense of their earnings and the outlook for FY25, so stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights.
Welcome back. We are now taking stock of Capri Global and how the quarter's gone by. And for that, we are in conversation with Rajesh Sharma, the MD of the company. Mr. Sharma, good morning. Thanks so much for taking the time out. Well, we are looking at a fairly stable top-line growth with about 27% year-on-year growth in your net interest income. Your net interest income also has risen by around 35%. So can you take us through the various factors behind the top-line growth, and also keeping in mind specifically the trends that you are witnessing in advances and deposits? Can we expect this through the course of the balance of this financial year?
Yeah, sure. Thank you. So I think this quarter we have seen a strong growth momentum in overall AUM. Our AUM have grown 11% quarter on quarter and about 50% up on a year-on-year basis. And that growth has resulted in a higher net interest income, and our margin have also improved because the higher interest rate spreads have resulted in this. This quarter, we also launched the Micro LAP product, where we'll be funding those customers below up to 5 lakh rupees of ticket size in a rural belt against their collateral to the small entrepreneur. So there's a new product we have launched. We have added branches. So now currently we are about operating with the 968 branches to work with. So the entire growth is happening because of the growth in the branches. The AUM have grown, and then we have seen that even our overall spread is also improving. So it is giving a good direction. Despite we launched our new technology, in-house built technology platform, which has taken a couple of months to stabilize. So we will clearly see that in the quarter starting from October onwards, we will see a full benefit coming of the technology, and this year should end on a very good note.
So hi, it's also Samina joining in. The numbers look promising, and like you said, the outlook also looks pretty strong for the rest of the year. Net interest margins have improved significantly in this quarter. Maybe not significantly, but yeah, about 60 basis points Q on Q. What's the outlook on margins going into the rest of the year? Do you think there could be upside risk to that number?
So I think margin should remain at this level, because we also seeing the cost of fund is going up. So any improvement in the margin to some extent will get offset by the increasing cost of fund as well. But overall, we should see a spread maintaining at about 7%, and which is higher by 70 basis compared to previous year, purely because the contribution from the gold loan and micro LAP will help to maintain this increased margin throughout the year.
Mr. Sharma, while we take your point on cost of funds, and I think that's more of an industry phenomena as we see it, but provisioning for this quarter is also almost doubled year on year. Is that simply in line with your net, your revenue number, or is that exceptional? What is behind you providing more for your accounts currently?
So we have seen some of the account from MSME restructured pool have slipped into the NPA, and being a conservative approach, we have made the higher write-off and provisioning in this year to clean up the balance sheet. And we believe that in the year ending, this will not be the phenomenon, and this will be overall in line with our credit cost less than 1%. So this is one of the quarter where we have seen that a lot of slippage have happened from the restructured pool. But on the next quarter onwards, this will be much better.
Right, Mr. Sharma, also a quick take on your expectation in terms of the way you expect the mix to come through over the next couple of quarters, and can that have some sort of an implication on your net interest margins? That's the first part of the question. And so should we start seeing the RBI cut rates? So how soon do you think there could be transmission, and what segments that Capri Global caters to would likely see that come through as well?
So, coming to the first part and second part put together, I think we cater to the MSME, which is a ticket size of about 19 lakhs, gold loan, which is a ticket size of 90,000. We cater to the home loan, affordable housing segment, ticket size again about 17 lakh rupees. So the entire portfolio is very, very granular. If you see, 80% book is a retail, and the 20% balance book is a construction finance. Again, that is also being done in a retail way. So if we come back to how the overall the contribution from each segment would look like, I think the MSME gold loan will be about 28-27% each. About 25% will be from the affordable housing segment, and about 20% will be from construction finance. So this is how the composition would look like.
Right. Well, Mr. Sharma, we leave it at that. Thank you so much for joining us and taking us through the quarter as well as what we can expect going forward. And with that, it's also a wrap on the F&O show. But before we end, Indiabulls Housing Finance Limited is now Samman Capital Limited. They say Jio Samman se. And keep watching NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial...
welcome. You're watching the Small and Mid Cap Show. I'm Mahima Vachrajani and with me is Harsh Saita, and we're also joined by Puneet Javeri today for this edition of Small and Mid Cap Show. Well, before we move on to the managements that we're going to speak to today, let's take a quick check on what the markets are doing. Well, the markets today have shown strength and stability after the Asian markets have cooled off. In terms of the Nifty is trading within a range of roughly 250 odd points, currently off from its day's highs, trading at roughly 0.83% higher. Sensex is also trading within a wide range of roughly 870 points, off again from its day's highs, however trading roughly 0.82% higher. Let's also quickly take a look at what the broader markets are doing. The broader markets are largely in line or doing a tad bit better than the benchmark indices. The mid cap 150 is up around 1%. The small cap 250 also, if we can take a look, it's up around 1.5%. Let's also take a quick look on what the contributors on the Nifty are. Something that's weighing up the Nifty is Reliance, Infosys, TCS, L&T. So a lot of IT names are seeing some kind of recovery. Something that's weighing down the Nifty is ICICI Bank, HDFC Bank, Bharti Airtel, SBI Life. Let's also quickly pull up the advanced decline ratio. It's skewed towards the buyers, the breadth of the market. Roughly 3:1 is the ratio. There you go. But Harsh, a lot of sectors, have also seen recovery today. Nifty Realty especially, it's up around 1.6%.
Yes, absolutely. So Nifty Realty was the most beaten sector yesterday in trade, at least at close. Let's pull up all of the sectors, in fact, and pull up the heat map itself. There you go, IT in the lead, down 4% odd yesterday. You also saw Realty, the second top gainer today. Again, yesterday was completely beaten. We spoke about that. But I want to try and focus in on a couple of defensives as well, because FMCG yesterday was probably the lowest loser in that sense. But we also saw some bit of pharma buying, which is happening today in trade. So there you go. The FMCG index is up and away in trade, but not as much. We're not seeing that larger bounce because yesterday the pullback wasn't as large. There you go. That's the pharma index as well. So we're seeing secular green, especially on sectoral indices. Let's pull up the bank Nifty as well, because that one is absolutely flat on a day like this. Absolutely no assistance given on both the index as well as the benchmark itself on the Nifty 50 by the bank Nifty, at least in trade today. So you're seeing absolutely flat on the bank Nifty, and most of the indices, if I can just quickly point out, we're at the day's low on most indices, the broader markets as well as the Nifty 50 as well. So where we go from here is something which we'll have our eye out on, just off the day's low. There you go on the Nifty mid cap. But let's quickly call on board our first management today. We have three. Let's call on board the first one. We have Keshav Bhajanka, who's the Executive Director at Century Plyboards India. Welcome on board, Mr. Bhajanka. Just want to first off try and understand how top line is evolved in terms of volume versus value.
Good morning. Thank you so much for having me on the show. I think we have had a very strong quarter in a highly muted demand environment. If you look at our plywood segment, YOY, our volumes would be up by close to 14-15%, and our value would also be slightly higher. Markedly, our realization would be up by about 1.5% further. If you look at MDF, we have faced some pressure in terms of realization due to an extremely competitive demand environment. However, having said that, we have still clocked in 25% value growth on account of 40% plus volume growth. Laminates have been more or less flattish, but across our segments, we have been within threshold limits of our margin guidance. So I think overall, it has been a good quarter.
Bhajanka, good morning and thank you so much for joining us today. Just wanted to get started with, one of the major segments, which is MDF. Now, if you could just quantify what was the volume growth in this particular segment in this quarter, and how has quarter two also started for, as the raw material price on that. But from MDF specifically, how are you seeing this particular quarter as well? Because EBIT margins are down roughly 90% for MDF specifically. So if you could just talk to us about this segment.
So in MDF, I think we should take the figures with a slight bit of a caveat. When we are looking at margin figures, I would advise to look at the standalone figures because we have a new unit that has just commissioned. It was commissioned on the 27th of March. So as you know, in the first quarter, a large new unit is not going to be able to ramp up that quickly. However, we were close to 14% EBITDA margins in quarter one. For our standalone unit. Overall, our volume growth has been 25%. Our value growth has been 25% plus, and this has been driven by a 40% plus volume growth. Going forward, we look at a stronger volume and value growth for the remaining quarters as we scale up our new unit in Andhra Pradesh.
Right. Mr. Bhajanka, so you've guided for an overall growth of 40% in MDF, and you've also guided for that 15% margin mark for the MDF segment specifically. So will you stick to that, or there's an upside to that going forward?
I think if we look at on a steady state basis, we will be at 15% plus EBITDA margins in MDF, and we will be at 40% growth. Like I've mentioned before, because the new unit has come into play and the new unit is gradually ramping up, I think we are going to see some short-term hits, but overall 15% EBITDA margin and 40% growth looks achievable.
Right. And Mr. Bhajanka, raw material prices of timber have overall gone up. So I want to understand how is the quarter two been so far, and what is the outlook for timber prices then?
I think timber prices will continue to remain inflated. This is a demand and supply mismatch, and as you know, plantation timber has its own cycle, so it will not be corrected in a day or a month. Having said that, in our plywood segment, we have taken a further price increase. We took a price increase last quarter, and we are taking a further price increase in the current quarter. So that will help us negate the impact of higher timber prices. In MDF, margins will continue to be under pressure. Hence, the guidance of 15% versus a 20% plus EBITDA margin of last year.
Now, Mr. Bhajanka, we had that a one-time impact in this particular quarter as well, which was about 13 odd crores. Now, we saw a similar impact of 19 crores in Q4 as well. And this is largely related to, subsidiaries being disposed of or assets being written down. If you could just talk us through that, and we've certainly seen some action in a lot of geography. So, is this the last particular quarter where you see this particular one-off impact of disposing of, or are there any other subsidiaries that would require this action in this particular year?
So I'd just like to clarify, this is actually related to the last quarter itself. However, what happened is the transaction got completed in the current quarter. As such, this is a book impact that we had to take in this quarter. It has zero impact on our cash flows, and the transaction is now already complete. It was supposed to be completed in March, but the transaction actually got completed in the first half of April. So this is a book impact that we had to take on account of the transaction being completed in April of this year.
So we are beyond the one-offs?
Yes, very much so.
Understood. With regard to expansion plans, what's in the pipeline? How much investment? Could you just quickly give us a lowdown?
So I think the majority of our capex is already done. As you know, we have commissioned our Andhra Pradesh unit, which is the largest unit in the history of our company. Now, there are only two substantial investments that are going to take place. A new plywood unit, which we are still contemplating in terms of which is the best location. That is going to be a capex of anywhere between 100 to 150 crores. And our particle board unit, where a substantial part of the capex is already done. And we are looking to commission that unit by Q4 of the current year. I think that will be a capex of 550 crores.
Just Mr. Bhajanka, if you could just deep dive a little bit into the particle board segment. We've seen, this quarter slightly subdued revenue growth, but the kind of capex investments that you've done, you're very positive on this particular space. If you could just talk us through a little bit of a long term over the next couple of years, how are you seeing this particular segment, pan out over the next couple of years specifically for you as well as for the industry? What is the kind of opportunity that you're seeing?
So there is tremendous competitive pressure in particle board, and hence we have gone for the new investment. The new unit that we are setting up is a continuous line. It is a different technology to the one that we currently have, which is a multi-delight press system. This is now going to be in line with the technology that we already have for MDF. So this will have a substantial increase in our EBITDA margins. Continuous press is far more expensive than multi-glide press. The reason behind the same is that it offers large-scale savings in terms of raw material consumption. So overall, once the new unit comes into play, we will be far more competitive and we will be able to drive a far better EBITDA margin. And that is the thought process behind setting up such a large capex. Alongside that, the market for particle board is substantially large and the market is growing. So I think we are well poised in that segment. And once the new line comes, we're going to be in a good position to ramp up.
Got it. And Mr. Bhajanka, you had taken price hikes of roughly 2% in May. So I want to understand going forward, are you planning to take further price hikes? Because, this will define the competition for you overall and also the impact of that price hikes on your numbers.
So you're correct. We took a 2% price hike in plywood segment in the month of June. And yes, we are going to take a further price hike in the current quarter. And I think we have still been able to post strong revenue numbers, strong volume growth numbers, despite the price hike. And I see that trend continuing.
Right, Mr. Bhajanka. Mr. Bhajanka, generally for a plyboard driven or the like kind of company, demand picks up maybe a year or two after pre-sales of real estate has happened, because you'll start to see those converting into projects, tangible projects, and thereafter, most residents will start doing interiors. Do you expect a real push going forward in terms of demand happening?
You are absolutely right. For a product like plywood or MDF or laminates or particle board, all the segments we are in, the product actually comes into play when it goes from a house to a home, when someone starts doing up their interiors. And I think we are seeing early signs that the inventory that was purchased is now being handed over. And hopefully the medium term is going to be very strong for us.
Got it. Well, Mr. Bhajanka, thank you so much for taking out time and speaking with us at NDTV Profit.
Thank you so much.
Yes. Let's shift focus to a new listing on the block. Akam Drugs and Pharmaceuticals debuts with a 7% premium. My colleague caught with the managing director, Sanjeev Jain, to understand the way forward for the company. Listen in.
Say we have always achieving around 15% CAGR growth year on year, and we are always making sure that all the we do have all huge capacities. We are the largest contract manufacturing company of the country, and we do have huge capacities lying vacant with us. We are working on around 40 to 45% of the capacity, wherein we can always increase the capacity. We are planning to set up. We have already set up few plants which are yet to be operational, and the where the market grows, we always grow, because we, being a CDMO player, we make sure that whatever the requirement come from the market, we has the capacity. We should have a capacity to make the products.
So,
and that will make sure that the growth of Akams will be there.
Right. So, as you said that we have grown 15% on a CAGR basis now. Can we see, how sustainable is this growth? Can we achieve like 20 to 25% growth in next few years, or 15% is kind of normal growth that we're going to achieve in next, say, 2 to 3 years?
See, futuristic goals should not be discussed. I don't think that this is the right time to discuss the futuristic goal, but we are very much sure whatever we have done, we will make sure that the same pace and same energy will be there. And now we have connected with so many people of the country, and those wishes will also support us to grow the business.
Okay, and as you said that the overall capacity of your business stands at around 40%. Now, what is the peak capacity utilization that you are seeing, and when can you achieve that?
Say, it depends on the product line to product line, but generally 60% is very easily achievable, and we can even go further. But we don't say target to achieve that 60%, because whenever we are say achieving around 50% of the capacity, we always make sure that one more plant or capacity to be built, so that enough spare capacity to be there for the country.
Also, Mr. Sanjeev, our EBITDA margin is currently low at around 12%. Now, could you explain the reason for this? this is low as compared to the peers that are into CDMO business? And are we expecting an uptick in EBITDA margins? Is there any room to increase these EBITDA margins?
In CDMO, we are always achieving around 15% for the last few years. This 12.5 is because of some lags of the business, like marketing business, like generic marketing business, and our API business. That's why. But both the business are now taking care, and the losses are not there now. Are not going to be there. We will be able to achieve the legacy of the margins.
Also, and Mr. Sandeep, I wanted to ask you about the export strategy that we have. So, you wanted to scale up exports to 25% with current 17% of the total revenue. So, what are the strategies over there, and when we can achieve this 25% target?
We do have 2 European GMP plants, which has not been leveraged till date, and we are already present in more than 60 countries, and so many dossiers has already been approved, and more than 200 dossiers are in pipeline. When they will get approved, and few of the products for European is also there in the pipeline, we will be able to achieve the CAGR very easily.
Okay, so that conversation happening with the newly listed company, but time to slip into a short break. On the other side, we will be joined by the management of Gujarat State Fertilizers to talk about the quarter gone by. Stay tuned.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching the Small and Mid Cap Show. Well, Gujarat State Fertilizers Chemicals came out with its Q1 FY25 earnings, where revenue was up around 5%, EBITDA down around 22%. Margins have taken a hit from 6.9 to 5.1%, and net profit was down 22%. But to discuss how the quarter has gone by and what the entire FY25 looks like for the company, we're joined by Mr. S.K. Bajpai, Senior VP Finance and CFO of GSFC. Welcome to the show, Mr. Bajpai. My first question to you is that margins have significantly taken a hit, and I understand that this is on the back of raw material pricing going up and subsidies that have significantly gone down. So I wanted your outlook as to how this will shape up overall in FY25.
So as you rightly said that in fertilizer industry, the subsidy plays a vital role in deciding the margins of the fertilizer companies. And this subsidy has been down in October 2023 by 35%. And in that same promotion, the raw material prices has not come down. So that is the reason why we have seen this reduction in the margins. However, if you compare with the quarter over quarter, there is significant improvement, and we have posted only 23 crore rupees PAT PBT that has been increased to 118 crores. So in the same level of the fertilizer subsidy, the quarter 4 versus this quarter has been a very good quarter as far as Q1 is concerned. And as far as the rest of the quarters are concerned, we have made certain changes in our product mix. And in Sikka unit, where we have the facilities to produce DAP, NPK, and NPS. So we have switched from the DAP to APS and NPK, where the profit margins are better than the DAP. Because the phosphoric acid consumption in DAP is much more than the other fertilizers, phosphatic fertilizers. So that is the reason we have switched to the APS and NPK. So the margins will remain the same or it will improve further because our volume growth is reported at 30% YOY basis and 22% on QOQ basis.
So, sir, let me ask about sustainability and where do margins go? You're suggesting margin improvement. By the end of FY25, exit FY25, where should margins be at? Where should we expect it to be?
Only I can say it will improve further. Whatever the 5 to 6% margins presently we have reported in the quarter, it will, going forward, it will improve because in the fertilizer industry, DAP production is very vital, and presently there is a contribution loss in DAP production because of the subsidy and MRP is fixed by the government, and the raw material prices are not coming down to that proportion. So we expect, or the whole fertilizer industry expects from the government to increase a little bit subsidy so that at least contribution loss can be avoided.
Got it. So, sir, closer to double digit?
I cannot predict that much, but 2% or 2-3% higher than present margins will be our expectation presently, because the subsidy is under the control of government and we cannot do anything.
Right. And sir, with regard to volume sustaining, growth has been strong. You expect that to sustain through FY25?
Yeah. The growth, whatever we have achieved, we are very positive. And we have arranged the raw material, phosphoric acid and ammonia, whatever is required for producing the APS and NPK at our Sikka unit. So the volume will be continuous as presently shown in the 30% growth in the current quarter. So overall, in the full year, we expect at least 25% growth in the volume.
And Mr. Bajpai, what is the kind of capex which will commercialize this year is one point I want to understand. What is the kind of revenue growth will you be expecting from that commercializing of capex?
So we are nearly capitalizing 1,000 crore of asset in this particular year. But the HX sulfate plant, sulfuric acid 5 plant and one urea revamping plant. So all these plants are for the betterment because we are having the plants of 60 years old, urea 2 and having higher consumption, energy consumption. So the government is also pressurizing to reduce the energy consumption in the fertilizer plants. So we are doing this 450 crore rupees expenditure for the revamp of urea 2 plant. So all this money is going for the betterment of the and sustainability of the plant's operation.
Okay, and what is the capacity utilization at present, and where do you expect this to go by the end of FY25?
It is nearby 90 to 95% in Baroda unit and little lesser in the Sikka unit because their phosphoric acid is the real challenge for getting up to the quantity what we require to produce, maybe 60-70%. But going forward, we will be anticipating 100% capacity utilization at Baroda unit and a maximum maybe 70-80% at Sikka unit.
Right. So I want to try and break down your cash balances and where you're going to put that to use. Where can we expect that? Because you're sitting on a very strong cash balance. even when I'm looking at some of the current assets, inventory plus trade receivables, it's quite a large number when I'm adding all of those up. So what's the plan here, especially with regard to cash?
So in the fertilizer industry is the seasonal market, no? So we are having a very good stock placed at the market because the good rainfall is predicted for the current year. So we have placed the inventory, finished goods inventory in the market, and whatever current assets we are having, that will be realized. Government is also very prompt to release the subsidy, and we have received the subsidy up to July, second week of July till now. So there is enough cash available with the company, and as you know, we are a debt-free company. So this money will be utilized for the further capex and project expansion project further as advised by the board. And we have the Sectoral unit where we are going to put PASA plant so that the phosphoric acid availability can be assured for the DAP and other NPK grades of fertilizers. And similarly, we are also having a land at Dahej where we are going to start the work, and we will use this cash for the putting some chemical products.
Okay, thank you so much, sir. That's all the time we have. Thanks for giving us all of that perspective. With that, we're out of time on the Smith Show. Stay tuned to NDTV Profit. Also, Indiabulls Housing Finance is now Samman Capital. Jio Samman se keep watching NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Hi, thanks so much for joining in. You're watching NDTV Profit. This is Ask Profit, and my name is Alex Matthew. This show is geared towards getting you answers to all of your stock-related questions. So, to that end, if you've got questions for us, you can send them to us on that WhatsApp number that you see at the bottom of your screen. Before we get to those questions though, and let's take a look at the markets and where they are right now. We had a stellar start to the trading session and quite the bounce from yesterday's sharp slide and sharp declines, but we are off the high point of the day. In fact, we are trading with gains of about 0.75% for the Nifty 50, and it is trading above the 24,200 mark, but we have given up ground. In fact, we are down, or we were down about 200 points from the high point of the day. We've recovered from that as well. The broader markets are trading with gains as well, and in fact, at this juncture, they're doing better than the benchmark. The Nifty 50, Nifty mid cap is up as much as 1%, and the small cap index is up as much as 1.4%. Most sectors are currently in the green, but the Nifty Bank has given up ground, and you will probably see that some of the declines for the benchmark are led by those banking names. Right now, the Nifty Bank trading just about flat, or rather, in fact, it was flat last I checked. It might just have changed. In fact, there you go. It is just about flat. It has recovered again from the low point of the day. But take a look at the contributors on the Nifty 50 and you will see an interesting picture here. Reliance Industries leading the gains purely by dint of the weight that it has on the benchmark. And you have HDFC Bank on the other side of the spectrum, which is losing ground. Not by a very large margin, remember, but it is proving to be a bit of a drag. Larsen & Toubro, TCS and Infi are the other gainers. Bharti Airtel losing ground as well as ICICI Bank, and I told you that the financials are not doing particularly well in trade today. Overall, the market breadth as a whole is tilted in favor of the advances, and quite the opposite picture from what you saw yesterday. Of course, yesterday it was even more stark in favor of the declines. But let's talk about the stock in focus, and it is in fact Brigade Enterprises. This is on the back of earnings, and the stock is doing particularly well in trade. Of course, here too, it is off the high point of the day, but all the same, it's trading with gains of over 5%. We've got Anushi joining in to set us up with what the latest development is. Anushi, the numbers stood out as quite positive, right?
Right. So now if you have to look at Brigade Enterprises numbers for Q1, quite a set of decent numbers that we are looking at. The revenue saw about a 65% jump to 1,078 crore, while the EBITDA also in line with the revenue growth saw about a 67% of a jump. So both of these metrics are above the Bloomberg estimates of 1,031 crore and 273 crore respectively. Margins also moved inched upwards to 27% as compared to 26.8%, and net profit, though it recorded about a 3.6x jump to 80.5 crore, this was still below the expectations of 97 crore. But this was on the financial metrics part. But even if you look at some of the other key metrics, which is the pre-sales, or rather the sales booked for projects under construction, the pre-sales saw about a 9% growth at 1,086 crore, while the pre-sales volume rose to about 1.15 million square feet as compared to 1.46 million square feet. Now, taking this into consideration, the average realization for the same stood at about 9,483 per square feet. But over here also, if you look at the segmental wise performance, again, the growth that we are seeing is led by the realty segment, seeing about a 105% growth, followed by leasing revenue, which saw about a 23% growth, and hospitality revenue clocking in a 11% growth. But on the other key developments for the company also that we should be watching out forward, the company has also signed an agreement for new office space in Bangalore. From year in, they expect to see a lease income of up to rupees 100 crore per year, and they'll be investing 750 crore for the same. So while Brigade is in focus today, if you look at its stock performance over different periods, it's in the last 1 week and 1 month, it has seen some weakness, 6% of a downtick, while in 1 month it has seen about a 9% of downtick. And if you take the 6 months concentration, the stock has seen about 12% gains. So this is all that we are gathering on Brigade Enterprises as of today.
All right, Anushi, thanks so much for getting us those details. Of course, there is something else that is also buzzing in the real estate space. Whether or not this is true is another matter. There could in fact be a review of the LTCG on real estate. No confirmation, remember, of that, but the realty index as a whole has been in focus all morning. Asta Jain of Hem Securities, as well as Swati Hotkar joining in this morning to answer all of your questions. Thanks to the both of you for taking the time. Pleasure as always having you on the program. Asa, I'll come to you first on Brigade Enterprises. What did you make of the earnings and what's your view on the stock?
Hi, good afternoon to both of you. Yes, talking about this counter, definitely the price momentum today is a reflection of the earnings and the strength in the earnings which this company has posted. So on the back of, we know that there's a strong growth in their sales because 65% of their basic business is only real estate, followed by lease rentals and then hospitality. So if I talk about this business of real estate, they have shown strong growth. Now, on the basis of the robust booking, their launch pipeline is very strong. So I think in future also we will continue to see strong momentum in their earnings from this counter, and hence we are positive on this counter. There is only one concerning thing about this is the premium valuations which it is quoting right now. So that is the only reason that we have not seen this stock performing so strongly in past few days. But now, after this earnings, definitely the stock has gained momentum. So our idea here is to stay invested in the counter with an initial price target of about 1300, but that too in the medium to long term, because right now premium valuations are already there in this counter. So it is a medium to long term buy call from our side for the possible target of 1300.
1300. All right. The stock is very close to that 1200 mark. So not a tremendous upside from this point. Let's jump into the queries. And just a quick reminder, you see that number at the bottom of your screen. If you're sending us a question for the first time, do tell us your name and your location. It will help you identify when we take up your question. The first one we're taking today is from Sahil, and he's asking about a company in the automotive ancillary space. He's talking about Motherson Wiring. And this is an interesting stock, of course. It's currently trading higher by 0.4% at about 70 rupees. The question is for the long-term prospects, though, and for the next 2 years. Asta, would you have a buy call on this?
So for next 2 years, right now, I think one can just wait for some more decline to come and then make a entry into this counter, because long-term prospects are very strong. But right now, the kind of market conditions we are looking, I think some decline can come in case if markets will not behave in the manner in which they are behaving right now. I mean, if they decline more from here. So talking about this counter, I think they have the diverse range of wire harnesses, and in fact, their technology is very strong. So I think going ahead, definitely this company will prove its mettle in their financial performance. But market conditions are like that only. That's why I'm recommending buying on dip strategy, not right now, maybe at the call of around 65. The stock is a better buy option with a price target of 80 to 85.
Okay, not a considerable upside based on the fundamentals. I'm coming to you for the next one, Swati, and this one is Z Entertainment. We've got Salim from Andhra Pradesh, who's holding Z. 4,000 shares, bought at levels of 177, which is elevated levels, and the stock is currently trading at 136 or thereabouts. Would you suggest holding on, or would you book a loss? He's asking when can he recover his buy price, if at all?
Good morning, both of you. Definitely the view on particular Z media is a little bit cautious. Why I'm saying that? Because from the year of 2020 itself, we are continuously facing a selling pressure. The stock is trading nearby its low level. We are witnessing a double bottom nearby 114, 120 levels. So downfall as of now, it's very restricted. Downside, it can come down up to 120 to 115 levels. So I will not suggest to sell or to book the losses at the current market price, because the risk reward ratio is favorable at the current level to average it out. So if you are getting any dips towards 215 level, you can buy or average this particular counter. I believe we might see some turnaround after forming some sort of a bottom nearby 115 level, and we might see some pullback rally towards at least 240 to 230 levels on the higher side. So at the current level, I will suggest to hold on, not to book the losses.
Okay, we've got Rohan Sharma who's got the next question. REC took a bit of a battering in trade yesterday. He's bought at levels of 587. And one of the concerns, I think, has been the unwinding of the yen carry trade and how it relates to the access to capital. Swati, or rather, Asta, I'm not sure how this affects the fundamentals because a lot's been said about the lending in this space, in the electrification space. Would you say that you should hold on? It's more or less at the market price from what I can see.
Yes, so I think hold is a better option at present moment of a time because I don't want that the investor should make any sort of losses by exiting route right now. So talking about this counter, yes, Rural Electrification Corporation, as we all know, it is into that only the funding, etc. of railways, and we think that definitely some numbers can be muted going forward, but in the long term the kind of demand is there. I think it will not going to affect the financials of the company, and in the short term maybe the coming quarter can be a muted set of number, but going ahead in the long term we can see again strength in the counter. So my idea here is to stay invested in the counter. Initial price target which I can attribute to this counter is 620 to 630. Right now I'm giving short targets because we are really cautious about the market, so I'm not giving any big targets to any of the queries today, but I think 620, 630 can be attributed to this count.
Okay, that's a fair point, and thanks for that clarification. We've got Jammu and Kashmir Bank to talk about next, and we've got Khurshid who's tuning in from Srinagar in Kashmir, and he's bought 20,000 shares at a price of 76 rupees, so he's in the green right now. The stock is up as much as 2.8% in trade today. The question is, what are the long-term prospects? And he's defined this as 2 years, Asta. On the fundamentals, would you hold on?
Yes, for sure. J&K Bank is looking strong in the long term because here the time horizon is 2 years, so no need to worry. The only thing which we have to see right now, how the deposit mobilization is being done, and for that, how the deposits are coming into the bank, because that is the key concern for all the banks across the board. So we really need to see that for the coming 2 quarters, we really need to see how the deposit situation is. But again, if I talk about the other parameters, I think their asset quality is okay. It is into the fine shape, and we can see some sort of increase in the margins also going ahead. So from the long-term perspective, it is a hold from our side. Initial price target, again, which I am attributing right now to this counter is around 135 to 140.
Okay, GAIL is the next counter that we're looking at, and I'm just pulling up the charts as we speak. It is up as much as 38%, 38.5% for the year to date, 2024. We've got Ramesh Walia from Chandigarh, who's bought at levels of 220. The stock is currently trading at 229, not too far away from the buy price. The question is, for the next 1 year, what are the prospects? What are the key levels to look at? And Swati, what is your advice on this particular stock?
See, Alex, the counter is really doing very well from the 2023 tweet. Check out the rally from almost the stock has given a breakout for 120 and non-stop it has rallied up to 240 levels. So at the current level, profit bookings cannot be denied, but probably the profit booking can be, we will be seeing at around up to 200 levels. And again, we will see some bounce back rally. The overall technical setup is really positive. We are not showing any, the charts doesn't show any sign of a reversal from the higher assets as long as it's just trading in the upward rising channel. So at the current level, you can definitely hold on the long positions. I believe 210 is the immediate support level. So as long as the particular counter holds that level, definitely one can go for a long position or hold its long position for immediate target of 270 to 280 levels on the high side.
All right, let's pull up Adani Green and see where it's currently trading. And this is a question from Uttar Pradesh, and Utkarsh Singh is asking about it. It's currently trading at just under 1800. And we've got Utkarsh, who's bought at significantly elevated levels. What's a view on the charts though, Swati? If you have bought at elevated levels and if you have the patience, would you hold on to this?
Alex, as of now, the stock is in the formation of a cup and handle pattern, which is being formed in the monthly charts as such. Now it is in the under the formations of the handle pattern. So we are getting very sideways momentum in the last few 3 to 4 month session. It's got stuck within the range of a 1700 to 1900 on the in between 200 points. It is consolidating. A breakout on either side will decide the clear trend of this particular counter. I will suggest to hold on because as long as 1700 levels are intact on the closing basis, I believe we might witness some more rally initial targets will be 1900. About at levels, definitely a swift rally can be seen towards to 2400 or so. So if you're looking for a longer term horizon or a little bit a shorter term horizon, definitely you can hold on this particular counter.
Yeah, just a clarification, Swati, because I was not sure of the buy price. He's bought at all-time highs or very close to all-time highs. He says his buy price was 2800. So with that information, would you still hold on?
Yes, definitely I will hold on because 1700 is acting as a very crucial support level. So till the time he has kept the long position, I will suggest to wait for more times. We might witness some turnaround in this particular counter. So take more 70-80 points risk and hold your long positions and wait for the turnaround levels.
Yeah. All right. Just a standard disclaimer. This is NDTV Profit, part of the NDTV Group, which is owned by the Adani Group. We have to slip into a very quick break. We'll take more of your questions on the other side, so do stay tuned.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
All right, welcome back. You're watching NDTV Profit and this is Ask Profit. The next question we're taking is from Praveen Kumar. He's writing in from Vellore in Tamil Nadu and he's asking about a couple of counters, BPCL and HPCL. He's bought significant quantity of both of these Asta. He's invested as much as 9 lakh rupees in mid-June and he's already making profits, he says, of about 10% in each of those. He's got 1,598 shares of BPCL and 1,357 shares of HPCL. He's willing to hold for the very long term, though he hasn't described what that is. He hasn't specified. What are the fundamentals that you would focus on and should you hold on? He's asking specifically whether he should be worried about Middle East tensions.
I think, but the way crude is moving right now, prices are still not reflecting that sort of concern. But talking about this, these two particular counter, what is surprising and what is positive about these two counters in their quarterly result was their underlying margins, and both of them has shown strong refining margins. So that is the major positive for these two counters. I think one can remain invested in these two counters, and if anyone wants to go any particular between these two, then we would like to go with BPCL. And the price target for the same initially at the initial level is at around 380 to 385 level. So both counters are looking good, but BPCL is our first choice with the initial price target of 385.
All right, NFL is the next, National Fertilizers, I should specify, is the next counter that we're talking about. It's currently trading at 134, and we've got Abhishek Mehta, who's writing in from Pune, and who has bought the price at levels of 152. He's holding 1,200 shares. He's asking, when can he recover his buy price and can he make money on it? Swati, what are the kind of levels that you would look at, and what are the charts indicating?
See, the chart's little bit cautious because in the month of the mid of July, we have witnessed a negative divergence on this particular counter. And that's why we are witnessing a selling pressure from almost 160 to levels to 134, 135. Now, it has, at the current level, it has a very cluster support nearby 125. So as long as 125 support levels hold, we might witness some pullback rally back towards to 153, 154. He might again regain its buying price, but yes, profit can be witnessed only if the stock manages to give a breakout of a 160. Then only we can witness new uptrend, or say the fresh buying sessions can be seen above 160 towards 180 level. My view is a little bit cautious. Try to exit whenever we witness some sort of a pullback rally towards to 160 levels.
All right. Interesting question, because we've seen considerable action in the primary markets, and First Cry is a company that has its IPO that opened today. As I am told, the latest update is that it is subscribed by about 3%. The company's already raised a considerable sum from anchor investors. Asta, have you looked at the prospectus, and what's your view? What's your call on this IPO?
Yes, we have came out with a report on this. So we are giving a subscribe rating to this IPO, but for the long-term purpose, because in the short term, we cannot predict the market's mood. As we have seen the yesterday fall, it was a big fall. Now, talking about this counter, it is one of the largest multi-channel retail company, and with a focus on the kids, mothers, especially, we can say young children. So they are focused on that. Talking about this counter, the major negative which seems prima facie to be about this company is their loss-making nature, because in the financials they have shown losses, but there are reasons to that, because they were into the expansion mode. They have opened various stores. So definitely, the cost which the company has incurred due to those reasons, we have seen the losses. But going ahead, we are believing that this company will be turned around by the FY27. So within the time frame of 2 years, we can see the profits on the company. We are positive on this counter because one major positive about the company is about their addressable market also. The size is huge. It is $48 to $50 billion. First Cry's addressable market. So they have a huge opportunity to grow. They have a strong brand. So we are recommending subscribe to this, keeping into mind long term. However, if markets move in the favor, then definitely some listing gain can also be seen on this counter on the listing day.
All right. And depending on the subscription, of course, you will get allocation. Let's see how that pans out. But from the secondary markets, again, this is a question for you, Swati, on Ujjivan Small Finance Bank. We've got Srinivas from Hyderabad, who's bought at levels of 55, and he's wondering what the long-term prospects are. He's defined that as 2 years. But what would your advice be based on how it's doing on the charts?
See, the charts as of now witnessing that this particular stock is just trading nearby its support levels, which comes to at around 40 to 42 levels. That is the cluster level we have seen since 2023. Now, at the current level, the stock is also trading nearby its oversold zones, which indicates that the selling pressure might not get intensified here soon, but definitely pullback rally can be seen in the short-term period of time. So as long as 42 levels are respected, definitely pullback rally can be seen up to 50 to 54 levels on the high side. If he's holding for a longer term duration, definitely he can hold on by maintaining a strict stop loss of 41 rupees on the downside. And if you're getting a breakout of 50 levels, then 55 to 58 levels can be seen.
All right, Satya has got this next question. HCC and Suzlon. He's wondering whether to get into these two counters from the perspective of the next 1 to 2 years. Swati, I'm coming back to you on this one because it is a question about a fresh entry into these two counters. Suzlon particularly has done incredibly well. What a story. But would you get into it at the current juncture?
Alex, looking towards the chart, I will not suggest to enter it at the current level. The current stock is trading at the level of 68. We have seen a very good rally in this particular counter. No wonder we might witness some sort of a correction or say the profit booking at the current market price. Any dips towards 250 level, definitely one can take a long positions into Suzlon, but not at the current market price because the risk reward ratio is not favorable at the current moment period of time. Coming towards the HCC, definitely this counter is also really doing very well compared to the Suzlon, but we need to wait for a sort of a correction or say where it will test the support levels of around 40 levels. So if you're looking for any fresh long positions, wait for in this particular counter, both the counters, HCC one can go for a long if it's tested 40 levels and just respect that level at least for a 1 to 2 days closing basis, then one can go for a long positions, but not at the current market price.
All right. One quick more question that we can take. IRFC is the name of the counter. And this is a question from Vardarajan. He's writing in from Chennai. He's bought at levels of 195.6. And he's got 20. I think the number of shares is wrong. He's got 34 shares. And he's saying that he can hold for the long term. What's the view on the fundamentals, Asta?
So I think it is the sole borrowing arm of the Indian Railways. And I think the fundamentals are solid for this company. We are expecting their margins to get increased going ahead also. We are like positive on this counter, recommending a buy as well as hold. Initial price target 195 to 190 it can be set on this counter.
Okay, fair point. All right. Unfortunately, we're completely out of time and I've tried to reply to everybody here, but those people that I haven't been able to speak to, unfortunately, we couldn't take your question today. But hopefully the answers that Asta and Swati have discussed today, or the stocks that they've discussed, have benefited you nonetheless. That brings us to the end of this conversation. Swati as well as Asta, thanks so much as always for taking the time. And viewers, we'll be back tomorrow to take more of your questions. In the meanwhile, do stay tuned. Lots more coming up on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
Hello and welcome. This is Hot Money. I'm Agam Akil, and in this show we take you through all the stocks which are buzzing or have been the flavor of the season. A quick look at how markets are faring. We've seen a little bit of temperance, a little bit of moderation when it comes to key benchmark indices, which are off days highs, but they've come off days lows as well. So it seems like a range-bound session now. At the moment, it's also the Fin Nifty expiry, a lot of banking stocks in focus. The Fin Nifty at one point in time, or actually it is still red, marginally in the red right now. It's actually flat, as you can see, not too much change there. And the banking index is looking at a little bit of reversion to mean, considering we're not looking at too much traction there either. It's only the Nifty which stands out, and that's up around 0.7% right now. All in all, a fairly mixed day of trade if you consider the broader markets too. Let's talk about the constituents of the Nifty to see where there's a pull and push when it comes to this specific index, where the heavyweights are panning out, and in terms of that, of course, Reliance Industries, L&T and TCS, which were heavily under pressure yesterday, are looking at a tad bit of recovery for now. Bharti Airtel, HDFC Life and SBI Life, on the other hand, weighing down in the indices to a certain extent, but it's a green day for the Nifty 50 specifically. Let's talk about the broader markets too. A little bit of an outperformance returning to the mid-cap and the small-cap indices. The mid-cap index is up around 1.2%. The small-cap index is up around 1.4%. Even in terms of the broader market gainers, we do have advances in a handful of names out there, which would include something like perhaps Godrej Properties, which is up around 3.8%. UPL up and about, that's up 3%. Gujarat Gas advancing, GMR Airports, Indus Tower, Concor, all of them up and about in trade. We also have something like a Brigade, which is advancing on the back of good earnings coming through. So these are just some of the names that we have as far as your advances are concerned. Not too much to speak for when it comes to losers. But, let's put the spotlight on Morpin Laboratories now. We have Sushil Suri is the chairman and managing director of Morpin Labs, and we understand that QIP is under the way. And to guide us through this conversation, I also have with me Varsha, who's going to perhaps take us through and lead this conversation here. Varsha, it's over to you.
Well, thanks Agam for that. So yes, company has actually raised 200 crore through QIP, and marquee investors have participated in this QIP. And to talk about that, we have Mr. Sushil Suri, who is the chairman and managing director of the company. Welcome, Mr. Sushil.
Thank you very much.
Well, I just wanted to know about the whole QIP, why you have raised rupees 200 crore, where you're going to spend this money into?
Yeah, Varsha, first of all, I would, through your platform, I would like to thank all the investors, all the stakeholders, and more particularly the institutional investors who have gracefully participated in this long-awaited capital raise. So we had only 4% institutional placements, institutional holdings in our company, and now that have gone to more than 10%. So that's a big, I would say, grateful moment for the company to thank all the institutional investors who have put their faith in the company. So we had an overwhelming response, and against our 200 crore offering, we had got 335 crore rupees, so which is almost 1.68 times of the offering. So at the last minute, we had to take a call that, okay, should we take more money? But internally, we could see that 200 crore is what we all need for the immediate growth plans. And coming specifically to the point that, okay, why we are in the QIP and what do we need, where do we go with the money? So Varsha, we had been growing at a very aggressive rate last couple of years, and the company as a whole, we have been growing at a CAGR of 17-18%, as against the industry average of between 10 to 12%. We have extra growth, and within the pharmaceutical space, we have API business which was growing at 17-18%, but our medical devices business have been overshooting, and we had got 27 to 28% CAGR year after year. So we could see that, okay, now we have a growth plan and India is booming as a manufacturing hub. So we could see that, okay, there is an opportunity for India to consolidate and create a position. We hadn't had a capital event for the longest time, and all the growth we were doing was from the internal accruals. And we are a debt-free company, so we never had any big investment even in the capex also and the working capital also. So now to capitalize on what the market opportunity is, so we approach the market and particularly the institutional investors that we need to think and plan for the long term. And for long-term investor, we needed institutional investors to support us. Naturally, we presented our case. So here we are that all the big boys, all the, I would say, big names, whether it is Citi, Nomura or Bank of America, Morgan Stanley, everybody is now there on our cap table. So we certainly had around 3.5–4%, including domestic institutions. Now Society General, Samsung India, Citi, all these people have participated. So this gives a good, I would say, both responsibility also and impetus also to the company, that we have all these people who will support us and I would say monitor us also, and we are happy to have these people on the table. And I would like to say through your platform again, right, to welcome all the new investors on the board of Moripin so that we can go together and create a better future. So coming specifically to the businesses, as I told, that API business had been growing very smoothly, 17 to 18% CAGR, a compounded annual growth rate. There, Varsha, we have got 7–8 products where we are the market leader. 6 products are there, we are number 1 to number 3, 4. 3 products we are number 1. Loratadine, Desloratadine, Montelukast, we are the market leaders globally in terms of the capacities. And now what we see is that another 3 products where we are number 3rd or 4th, there also we can be 2nd or 1st if we try to do that. Atorvastatin, Fexofenadine and Rosuvastatin. So what we are trying to do is build more capacities for the products what we already have so that we can gather the more leadership position. And more importantly, Varsha, is that we try to do more of new molecules. So API is all about new molecules and research and having processes and patents which are unique. So we are now trying to make a strategy, or rather I would say formulated a strategy, that we need to expand our capacities. We have a limited capacity, only 400 kiloliters, and that capacity is being added to 600 kiloliters, from 400 KL to 600 KL. And this will give us an enhanced presence in the market in terms of our delivery, addressing to the customers. We are exporting to 80 countries already, and there is a phenomenal rate of growth in almost all the continents, whether it is US or Europe or Middle East or Asian countries. We have been growing consistently over all the countries. So now what we want to do is to cater to all the growing needs. We need to build more capacities. Very simple thing. We have to do more of what we are already doing. So second,
Please go ahead.
Yes. So here, Varsha, our capex requirement for the API division is 75 crores. And out of the 200 crores after expenses, we get 187 crores. 75 crore goes to capex of the API division. And then the second division, which has been giving, I would say, phenomenal and interesting growth, is medical devices, as I shared with you. So there we have 2 lead products, I would say, glucometer and BP monitors. We are market leaders in both BP monitor and gluco monitors, and in both the cases we hold good presence in the market in terms of shares and the growth also. So glucometers, we have around 1.2 crore meters already installed in the market, and which becomes our customer base. And of course we keep on supplying strips year after year. So it all depends how much market base we have, how much customer base we have. So around 11–12 million customer base we have got, which is, I would say, feeding our regular sales. So we are increasing the capacity of glucometers. So we have end-to-end backward integration in glucometers. We manufacture it from bare chips. So we have our own SMT machines, we have assembly lines, we have injection molding machines. So we are fully integrated in the medical devices, and now we are adding more machines so that we can supply more and more medical devices to the whole world. And India being the hub of the world, So once we build larger capacities, we want to make our space for the global capacities also.
Well, Mr. Suri, I understand that, but one question that I had was, I don't want any kind of guidance to this, but the company has achieved a CAGR growth of around 16 to 17%, as you rightly said. Now, looking at the long-term perspective, not the shorter term, do you believe that company can achieve growth rates exceeding this number, considering the QIP that you have been doing?
Look, as you said, that I'm not saying that it's a guidance, but I would say that is an effort, and that is a whole pretext what we are working upon, that if we have to continue on this growth, so it was not possible without additional capital. So that is where we need to have a capital raise, that is where we need to have, I would say, more new product portfolio, new markets, and of course more control. And I would say, depending on the way India is having an opportunity, so we are at the opportune time. Of course, we all know that China is disturbed, and of course we do have impact of the Chinese raw material supply. The prices are up and down, but we are, as a Morpen, we are seeing a lot of opportunities, and we are hopeful that we will be able to maintain this ratio. Whether it is 15 or 16 or 17, these exact numbers naturally no one can predict, but we see a lot of opportunities.
Also, who would be your large and branded players in this medical devices space, and also a lot of EMS companies are coming into this space. So how do you see competition as a whole for your company?
Varsha, basically this line is very technical, so I will not count these EMS companies to be part of this, because this line needs a lot of trust. This is not just a device. So as Morpen, as Dr. Morpen is a brand, we have established this Dr. Morpen brand since last 24 years now. So people believe on us, people rely on our service, and it's all service oriented thing. It's not like you just pick up any fixed thing from a toy store and okay, that's it. But what we do is a lifetime free replacement of the meters. We have service centers all over the country. So, and of course we go through pharmaceutical trade, we go through distributors, pharmacies and all that. So EMS companies are not my competition. But coming specifically to the pharma competition, the one big company is an international company, and you might be knowing it's Roche, who has been neck to neck, and they are there since last 30-40 years. So I won't say that they are big or I'm small, but they are there in the market. But of late, we have been able to surpass the number of meters supplied and number of strips supplied in the market. And of course, we are gaining share day by day. So I don't have any official numbers that what's the market data, but our share is between 20 to 21%, and I'm assuming an equivalent share with them. So rest all is a long tail. This long tail is what has been typically available during seasonal time. During COVID time, many companies had come, and many companies have folded after that. And one of our companies in our Parvanu, Baddi neighborhood, they came during COVID, they folded within 1 year. So I would say that's a long tail. I don't see that as a competition. But as Morpen, we have been able to build a very beautiful model wherein not many companies are there, unlike a typical pharma where we have 50, 60, 100 brands of one particular thing. Here we have one or two brands. Of course, we are in a competitive market. But India is the diabetic capital of the world. And of course, so is the largest number of cardiac patients in the world. So we see a lot of opportunity in this market, and it's a niche market, and it's early days, I would say, but the growth potential would be much higher. So that is where I say that this has been growing at a CAGR of 27-28%. So I think that's an interesting thing. If we, in today's age, we get some business which grows at 37-38%. Last year, medical devices grew 35%. So of course, it's a smaller base of previous years, but we are comfortable and confident on this part.
Okay, Mr. Suri, so we leave it at that. Thank you so much for joining us, and well, all the best for your future plans with respect to the company. Of course, as far as our viewers are concerned, we'll continue to give you an update on this one. Also thanking my colleague Varsha for joining us and guiding us through that conversation. But with that, it's time for a short break, and we will be back with a lot more in terms of stocks. Well, back in just a bit. Stay tuned in.
whole day passes like a blur. The news just whizzes past. And you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back to Hot Money, and we are now taking stock of all the companies which will be in focus at the moment. When we're talking about Brigade Enterprises, the kind of stellar earnings that they've come up with, we're also going to address Bharti Airtel, ONGC, and of course, if we have time, we will talk about Tata Chemicals as well. And to take us through these themes, well, we are now in conversation with Raghvendra Kedia. He's the founder of Prosperity Advisors. Raghvendra, good afternoon. Thank you so much for joining in. Let me just introduce the first topic to us by getting my colleague Anushi into the picture, who is going to tell us about Brigade Enterprises and how the quarter's been. Anushi, over to you.
Right, so now if you have to look at Brigade Enterprises numbers for Q1, quite a set of decent numbers that we are looking at. The revenue saw about a 65% jump to 1,078 crore, while the EBITDA also in line with the revenue growth saw about a 67% of a jump. So both of these metrics are above the Bloomberg estimates of 1,031 crore and 273 crore respectively. Margins also moved inched upwards to 27% as compared to 26.8%, and net profit, though it recorded about a 3.6x jump to 80.5 crore, this was still below the expectations of 97 crore. But this was on the financial metrics part. But even if you look at some of the other key metrics, which is the pre-sales, or rather the sales booked for projects under construction, the pre-sales saw about a 9% growth at 1,086 crore, while the pre-sales volume rose to about 1.15 million square feet as compared to 1.46 million square feet. Now, taking this into consideration, the average realization for the same stood at about 9,483 per square feet. But over here also, if you look at the segmental wise performance, again, the growth that we are seeing is led by the realty segment, seeing about a 105% growth, followed by leasing revenue, which saw about a 23% growth, and hospitality revenue clocking in a 11% growth. But on the other key developments for the company also that we should be watching out forward, the company has also signed an agreement for new office space in Bangalore. From year in, they expect to see a lease income of up to rupees 100 crore per year, and they'll be investing 750 crore for the same. So while Brigade is in focus today, if you look at its stock performance over different periods, it's in the last 1 week and 1 month, it has seen some weakness, 6% of a downtick, while in 1 month it has seen about a 9% of downtick. And if you take the 6 months concentration, the stock has seen about 12% gains. So this is all that we are gathering on Brigade Enterprises as of today.
Okay, Anushi, thank you so much for getting us that update on Brigade Enterprises. Raghvendra, your view on Brigade, how are you looking at things here?
Agam, broadly the numbers have been beating the overall estimates. However, when we look at Brigade on a valuation metrics, we see that the full year EPS comes at around 18 rupees, the earning per share. And that gives the company at current price of 1190 a P multiple of 60-63, which is extremely expensive if you compare it with the entire real estate space, specifically with their immediate peers like an Oberoi Realty or a Prestige Assets. On valuation metrics, this company seems to be expensive. Even the ROE at current stellar numbers looks at to be around 8% to 9% on a full year basis. So the return on equity is also in single digit, which makes the valuation at 60 times P multiple very expensive. So we would actually take this uptick as a selling opportunity and book our profits in case if you are holding the stock. If someone is not holding, then the better entry level would be somewhere around 1050, 1050. On valuation metrics, the company is expensive, so it could be sold and looked at as a booking profit at current levels of 1190 on Brigade Enterprises.
All right. That's Brigade, and we move on to taking stock of how Bharti Airtel has panned out. And for that, we now have Rucha joining us. Rucha, over to you.
For brokerages, I'll just give highlights of the results. Positive on India operations, revenue was up about 2%. Net profit was up 7%, whereas wireless revenue was up about 2%. The other highlight is that ARPU was flat, around like 2 rupees up, around 211 versus 209 in the previous quarter. Now coming to brokerages, Citi is the most bullish one with around 19% of upside and a target price of 1750. Now it said that India capex shows sign of moderation according to the management commentary in the past quarter, and this is what drove the free cash flow higher along with deleveraging. Now this is when the brokerage house expects that shareholders could get dividend and buybacks from Airtel. Also talking about JP Morgan has a moderate upside of around 2%, but it was surprised positively on the India capex stability and acceleration in the free cash flow. Now revenue growth was strong in the homes segment, and Bharti Airtel also announced deferring of calling the partly paid up shares due to strong free cash flow and generated by lower capex and deleveraging. Now according to CLSA is also bullish on Bharti Airtel with upside of about 5%. The consolidated numbers were largely dragged because of African business, because of deleveraging, because of devaluation of the currency. Board also feels that there is no immediate funding requirement, is what CLSA has to say on the stock.
Right, Raghavendra, come in on Bharti Airtel as well. We've had the earnings come through. They've also taken price hikes, potential price hikes in the order over the next 12 months as well. Your view here?
So Bharti Airtel, the numbers broadly were in line, but few concerns we come across with post these earnings are the revenue per user, the ARPU has been flat. Even the revenue growth at a consolidated basis is just around 2.8%. So pretty much not impressive on the revenue growth as well. Standalone basis, the India business is doing well in terms of the capex, in terms of the overall revenue and profitability. But on a consolidated basis, where the African business also kicks in, the overall company of Bharti Airtel looks like a pretty much steady in terms of the growth potential. So at current levels of 1450, we would not actually enter the stock, wait for a steep correction, considering the P multiples are also north of 70. And there is stiff competition from the existing large cap players across Indian geography, which is where they have done well. So considering the heavy competition and flat revenues on a console basis, we would actually not get into a fresh entry at Bharti Airtel, wait and watch for another 2 levels and see if the African business kicks in. Until then, wait and watch at levels of 1440.
Okay, there you have it. That's your view on Bharti Airtel. We also had ONGC announce its earnings, and let's take a look at how they have in fact come through. We now have Mihika who's joining us to give us an update on that one. Mihika, over to you.
Yes, Adam. It was a weak set of numbers, but this was expected by the market. Revenues were flat at 1.66 lakh crores. EBITDA did come down 6% on a quarter-on-quarter basis, and net profits were down almost over 11% at 10,235 crores. But this was in line with expectations. One of the main reasons why the weak performance did come in was due to lower production. Crude oil production was down 1.4% on a year-on-year basis, and gas production, which is key, was down 4.1% on a year-on-year basis. When we talk about net realizations for the crude oil segment, the crude oil via nominated blocks, the realizations were up 8.8% on a year-on-year basis. Even the crude oil produced via joint ventures, the realizations for those were up 14.2%. But the main weakness did come through with the gas realizations, which were down 3.1% on a year-on-year basis at 6.5 per million metric British thermal unit, which is mandated by the government itself.
All right, Mika, thank you so much for that update on ONGC. Raghvendra, we've seen gains in ONGC, but that's largely on account of the way crude has panned out. What's the way forward here?
So the earnings, if you see Agam, as Mika mentioned, they have been pretty much in line. What we like about ONGC has been the steady set of earnings. On a quarter-on-quarter basis, their earnings largely fall around 8 rupee on an EPS basis. So that gives you a full year EPS of around 32 to 35. And if crude goes up, we would consider that at 35 levels. And if you give a moderate multiple of 11 times, we get a price target of around 380, 385. So that is still a 20% upside from current levels of 315, which is what we would expect ONGC to perform in the 9 months ahead to 12 months ahead time horizon. So we expect this cheaply valued company versus its entire refining peers to do outperform and the catch-up play to happen. If you see ONGC on a valuation metrics, it is still trading at 1.2 times its book value, which is extremely cheap. Another great point about ONGC is a very generous dividend payout policy, around 3% per annum. So that's very comforting. On dividend payout basis, cheaper valuations and inline earnings, we believe that ONGC becomes a good buy at current levels with a 20% upside and a price target of 385 for a 1 month horizon. It's a good, safe and steady bet at current levels.
Okay, and Raghvendra, a final company that we want to address is Tata Chemicals. It's not been the best of quarters, but perhaps on expected lines because the entire sector has been reeling under a tad bit of pressure. Still, your view here, and what would you do with Tata Chemicals at the moment?
So as you rightly said, the entire sector is under some selling pressure, but the numbers have been pretty much steady in terms of the earnings reportings of Tata Chemicals. We still believe that there is headroom for upside and a price target of 1250. Good corporate governance, steady income growth, and slow and steady capex plans. They are doing walk the talk in terms of executing their expansion plans. And the geographies of Europe and US, the numbers have been pretty impressive. So 1250 could be a target for a 1 year time horizon. Tata Chemical also is a safe bet in terms of their good management and a steady earnings growth.
All right, Raghvendra, we leave it at that. Thank you so much for joining us and taking us through your views on the 4 stocks that we wanted to talk about today. And with that, it's also at the end of this show. But stay tuned to NDTV Profit for more news and updates, and we'll be back in just a bit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Let's be real, guys. There are many financial experts out there.
Well, there is a bit of a bounce in equity markets after Monday's carnage. The question is not just about what a trading mind should do, but even if you're an investor, how do you approach a situation which is as volatile and as uncertain as is right now, because there are 2 or 3 moving parts to this whole picture. Let's try and understand what a long-only fund manager is thinking about in a situation like this. Pankaj Tibrewal, founder and CIO of Ikigai Asset Managers, joins us right now on the show. Pankaj, great having you. Thanks for taking the time out, and an opportune day to have you really because of all that's happening around us.
Thank you, Neeraj. It's a pleasure to join the show.
Thank you so much.
I'm looking forward for the conversation.
Yeah. How do you think about what's currently happening, Pankaj? Because there is a fair degree of uncertainty with regards to the yen carry trade impact, with regards to what the Fed does or doesn't do and the resultant impact, and a renewed bout of geopolitics hovering above us.
So I think it was a combination of all three. And, Neeraj, in various shows of yours in the past few months, we have been pointing about the excesses on valuations which have been created. And reasons are known on the hindsight always. And the reasons came in the form of yen carry trade, geopolitics, slowing down of US economy. But I think the trigger was that asset bubbles were getting created across. Look at what happened in the 2-week period. The US volatility index, which was sub 10 just 2 weeks back, touched a high of 80 yesterday. And think about the algorithms, the entire machine trading, portfolio-based things, which created that. So I think one thing which we have learned over the last 2 decades is that it's futile to make a prediction about the future events. I think, at least for myself, I know I'm very realistic about my abilities in life, and it's very futile to make predictions of the future. What you have to focus on is portfolio construction to make sure that your portfolio survive across cycles. And I think this volatility is going to stay for some more time. And I think my sense is that there could be a shift in sectoral allocations after a sharp knee-jerk reaction which we saw globally over the last few days. And don't forget, in the last 3 trading days sessions in August, the entire gains in calendar year in Japan has been wiped off. Such are equity markets. So we believe that you should always weigh your risk reward. In today, many sectors which I see even in India, the risk reward is not in your favor. The valuations are excessive. There is narratives. There are thoughts, stories prevailing out there in the market. And one needs to be careful of what not to do. And I think this is a market of elimination rather than selection. I think you need to eliminate what you do not invest in, because many places I see there is a risk of permanent loss of capital because only narratives are floating around. There's very little delivery on cash flows and earnings.
I'm going to get back to these last 10 words that you used in just a bit, Pankaj. But I want to come to the major question first. Reasons come later, but reasons cause corrections. Is 4% a correction enough, or does it need to be more? Do you reckon it can be more?
It's a tough question, to be honest, Neeraj, but look at some of the data points. I think the market has been too charitable to all of us over the last 2 years. And most of the stocks have made you money across. When I look at the data points now, I believe that the market breadth has started to narrow down. Why do I say so? Last year, the earnings growth across on a headline basis was 30% for NSE 500 companies. And many companies delivered 50 or more than double their earnings also, because margin was an important lever for earnings growth. FY25, the first quarter had started on a very subdued note. 300 companies out of the 500 NSE 500 have reported till day before yesterday. And the headline number is just 3% earnings growth. And when I bifurcate this 300 into 2 parts, 71 companies are banking and financial services company. They have grown their profits at 21%. But the 229 companies are